Very good morning, everyone. How are you all? Chalo. Last class, whatever we have done, in that any doubt? No doubt. Today we'll start a very important chapter, financial instrument. Revision of financial instrument. I hope you know that this chapter consists of three Indias. Indias 32, Indias 109 and Indias 107. Indias 107 is related to disclosure requirement. So this is not important from examination point of view. You will not concentrate on Indias 107. You will concentrate on Indias 32 and Indias 109. Correct? Indias 32 deals with what? Presentation of financial instrument, and Indias 109 deals with the recognition and measurement of financial asset and financial liability. Means, what is the scope of this chapter? If you see, the scope of this chapter is what? Everyone, the scope in the balance sheet, if you see, this is asset and this is equity and liability. Correct? Balance sheet, asset, equity and liability. So from this chapter point of view, all assets are of two types. One is non-financial asset, one is financial asset. And liabilities are also of two types. One is non-financial liability and financial liability. And of course we have equity. So this chapter deals with financial asset, financial liability and equity. Means non-financial asset and non-financial liability are not covered in this chapter. If you say example of non-financial asset, the example of non-financial asset means what? Property, plant and equipment already we have covered. Intangible asset already we have covered. Investment property already we have covered. Biological asset already we have covered. Inventory already we have covered, etc. Correct? Means whatever left which are not a financial asset will be financial asset. Means simple. When I say simple meaning, financial asset means right to receive. Right to receive. But which right? Contractual right to receive. So any amount means contractual right to receive cash or any other financial asset will give rise to financial asset. However, we need to do some detailed discussion on that. Similarly, financial liability means the contractual obligation to pay cash, and equity means what? All asset minus all liability is equal to equity. So this chapter will focus on what? Financial asset, financial liability and equity. Means can I say financial asset will include debtor, it will include any loan receivable, it will include any investment. Correct? Financial liability will include creditor, it will include debenture, it will include redeemable preference shares. Correct now? Or any loan taken means loan payable. Yes sir, correct. So we need to understand what is the meaning of all these items. So what is the meaning of financial instrument? What is the meaning of financial instrument? You can see financial instrument is a contract. So it means, can I say this chapter start with contract? If there is no contract, then this chapter is not applicable. For example, if I say income tax payable, so income tax payable is also, there is an obligation to pay in cash. So income tax payable, there is an obligation to pay in cash, but not under a contract, because there is a statutory obligation to pay income tax. Therefore, income tax payable is not covered in this chapter. Even though there is a obligation to pay cash, but it is not under a contract, therefore outside the scope of this chapter. Are you agreeing? Yes sir. It is a contract which give rise to financial asset of one entity or financial asset of one entity and financial liability or equity instrument of other entity. Means under a contract, whatever contract you are entering into, if it is giving rise to financial asset for your entity and financial liability or equity instrument of other entity, then it will become what? Financial instrument contract. Now we need to understand what is the meaning of financial asset, financial liability and equity instrument. So they have not given the definition of financial asset. The definition of financial asset is one type of inclusive definition. Inclusive definition means they have given this type of asset will be financial asset. Correct. Now, so what type of asset will financial asset? So it includes, you can see inclusive definition. It includes cash. Of course, cash is a medium of exchange. So cash will be always financial asset. Second, equity instrument of another entity. Any equity instrument of other entity will be our investment. Means in our books it will be investment in equity instrument. The investment in equity instrument will be always financial asset. Even though you can see under equity instrument there is no contractual right to receive cash. Means for equity instrument there is a contract, but there is no contractual right to receive a defined cash. Correct now? Then also it will be a financial asset. So this is one exception to the rule. One exception to the rule. So can you say point number B? Point number B is what? Equity instrument of other entity. Point number C, you can see it include contractual right to receive cash or another financial asset from another entity. Means it will include all types of contractual right. For example, trade receivable, investment debenture, loan given to employee, etc., etc., bills receivable. Whatever is receivable will come under this point if it is under a contract. If it is under a contract. Then point number D is what? Contractual right to exchange. Contractual right to exchange financial asset or financial liability with another entity under conditions that are potentially favorable to the entity. So whenever we say under a condition that are potentially favorable to the entity, so only one example will come in our mind, that is derivative asset. So I hope you all know, because you have done SFM, you all know about derivative. Derivative example can be future, option, forward contract. So if it will give rise to financial, means if it will be what? Contractual right to exchange, then it will be what? Financial asset. The contractual right to exchange financial asset or financial liability with another entity under a condition that are potentially favorable to the entity. This point number E I will discuss, but not now. At the end of the chapter I will discuss, even though you might be knowing, but I don't want to discuss right now. The point number E is differed from my point of view. Correct? Yes sir. Now coming to financial liability. Okay, financial liability will be just opposite of financial asset. Just opposite of financial asset. So can you say for point number A of financial asset, there cannot be any negative cash now. Cash cannot be negative. Therefore, point number A will not come where? In financial liability. Point number B, equity instrument of other entity will become equity of other entity. So equity is not financial liability. Therefore, point number B will also not come in financial liability. Correct. But point number C, what is the opposite of that? Contractual obligation to deliver cash or another financial asset to other entity. Correct. What will be point number D ka opposite? Contractual obligation to exchange financial asset or financial liability with another entity under conditions that are potentially unfavorable to the entity. Unfavorable to the entity. Correct. So can you say, when I am saying just see financial liability means what? Contractual obligation to deliver cash or another financial asset to another entity. Point number B is what? Contractual obligation to exchange financial asset or financial liability with another entity under conditions that are potentially unfavorable to entity. Point number C, I will defer it, means point number E of financial asset is deferred, point number C of financial liability is deferred from my point of view. I can take right now also, but I don't want to take. Correct? Understood. Means can you say overall, if you see what is the definition of financial asset? Right to receive under a contract. Financial liability, right to pay under a contract. One exception, equity instrument of other entity will be also financial asset, even though there is no contractual right to receive. Are you able to understand? Correct. So can you say the definition is very much clear? Then what is the meaning of equity? What is the meaning of equity instrument? Equity instrument means any contract that entitle the holder of that instrument. Any contract that entitle any contract that entitle the holder of that contract the residual interest in the asset of the entity after deducting all liability. Can you see from bachpan we are doing accounting equation, equity is equal to asset minus liability. So from the bachpan we know the meaning of equity, asset minus, asset means all asset, not only financial asset, all asset minus liability, liability means all liability, that residual interest will become equity instrument, correct? Means can I say if I am saying which entitle the holder, so who is the holder of equity instrument? Equity shareholders. So if the under a contract equity shareholders are entitled the residual interest in the company, that become equity for the company, that become equity for the company. Understood? Example, can I say example will be non-puttable ordinary shares or equity shares issued by the company. Non-puttable means non-puttable. I hope you know about put option. What is the meaning of put option? Put option means what? Right to buy or right to sell? Right to sell, correct now. So if it is non-puttable, so if you just remove non-puttable right now, don't focus on that. Can you say any ordinary equity shares will be what? Any ordinary equity shares will be what? Equity only, correct? Similarly, can I say if I say irredeemable preference shares, irredeemable preference shares, so if I am saying irredeemable preference shares will be also equity, will be also equity. There are many other examples also, but we'll not take right now this example. Automatically you will understand with the later discussion, correct? Now when I am saying example, identify financial asset and financial liability. Of course now we can identify which one is financial asset, which one is financial liability. So can I say cash is a financial asset, cash equivalent is a financial asset, bank balance is a financial asset, deposit given is a financial asset, deposit received is a financial liability, trade receivable financial asset, trade payable financial liability, bills receivable financial asset, bills payable financial liability, loan, any type of loan is financial liability, loan received is a financial liability, loan given is a financial asset, investment in equity shares financial asset, investment debenture financial asset, promissory note to receive government bonds. So any promissory note, I think in bachpan you have done one chapter, bills of exchange and promissory note. So promissory note to receive government bond, and government bond is a financial asset. Government bond means right to receive cash. So promissory note is a contract to receive another financial asset, will be also financial asset, will be also a financial asset. This is also financial asset. Promissory note payable in government bond is a financial liability. I hope you are understanding. Perpetual debt instrument held. Perpetual debt means irredeemable debentures. Irredeemable debenture held means we are holding it. So it become investment in irredeemable debenture. So it will be also financial asset. Prepaid expense. Can I say prepaid expense contract? But there is no right to receive cash. There is a right to receive goods and services. It is not a financial asset. So you can see prepaid expense are not a financial asset. It is under a contract, but there is a right to receive goods and services. Goods and services means what? It is a non-financial asset. Therefore, it is not a financial asset. Inventory, not a financial asset. PP, not a financial asset. Intangible asset, not a financial asset. Advance given for goods and services. So advance given, there is a contract, but to what? Advance given to receive what? Goods and services. Therefore this is not a financial asset. Similarly, advance received, not a financial liability. Are you getting? But suppose you have given advance to any employee which will be settled in cash. If you have given advance to any employee which will be settled in cash, means it will be received in cash, then it become what? Financial asset. It will become financial asset. Deferred revenue means pre-received income. Any pre-received income means, can I say, we need to settle in goods and services. So that is also not a financial liability. Warranty obligation. Can I say warranty obligation means it will be also settled by providing services. So therefore this is also not a financial liability. Income tax payable in cash, but not under a contract. Therefore it is also not a financial liability. Correct? financial guarantee received. So any financial guarantee received or financial guarantee given in DAS 109 says this will be also covered in this chapter. We'll understand what will be the accounting treatment of that. This is a new point in your life. Financial guarantee received, financial guarantee given. Till now, means till before this chapter, we used to say guarantee is a contingent liability. We have never shown guarantee in our balance sheet, but now in DAS 109 will says guarantee will also come in the balance sheet, but it should be financial guarantee. So any financial guarantee received, financial guarantee given will be also financial asset and financial liability. Any ROU asset, this is not correct. This is also not a financial asset. ROU asset, right to use asset, means in DAS 116, it is also not a financial asset. Mandatory redeemable preference shares, compulsory redeemable preference share will be a financial liability. Correct now. Gold, not a financial asset. Any gold bond held, if you are holding some gold bonds, so it will be redeeming cash only. It will be realizable in cash. Therefore, it is a financial asset. But gold is not a financial asset. Understood? I have taken some examples so that if you have doubt, it is clear. Understood? Now, if any example is coming in your mind, you can ask me that also. Any example coming in your mind? Follow. Any example coming in your mind? No example. Can we proceed? Now, in this chapter, just try to understand. If you see this, what we have said, financial instrument is a contract which will give rise to financial asset for one entity and financial liability or equity instrument of other entity. So can you say in these books, in the books of this entity, there will be one doubt whether it is a financial liability or equity instrument. In this book, there is no doubt. If there is a contract, so that contract will give rise to financial asset of that entity. No doubt it will be always financial asset, but doubt will come in the books of other party whether it is a financial liability or equity instrument. Means just try to understand. If I say the company has issued equity shares, so in this case it will be always financial asset investment in equity shares, but doubt will come यहाँ पर कि whether it is a financial liability or equity instrument. So can you say we need to understand some classification rules कि when it will become financial liability, when it will become equity instrument, when it will become financial liability, when it will become equity instrument. The rule is very simple. But in DAS 32, whatever right now we are doing, that is based on Ind AS 32. So what Ind AS 32 says that if the issuer of the instrument, means the company who has issued that instrument, understood, means any entity which has issued that instrument. So there are two parties, one is issuer, one is holder. One is issuer, one is holder. So if the issuer of the instrument can be forced to redeem both principal, can be forced to redeem principal amount and to pay interest or dividend, can be forced, means there is an obligation to pay. If there is an obligation to pay both, if there is an obligation to pay both principal amount and interest or dividend amount, it is financial liability. It will be always classified as financial liability. Understood? Correct. Now, second point, if the issuer has an unconditional right without any condition, if the issuer of the instrument has an unconditional right to refuse, to deny, to refuse the payment of principal amount as well as interest or dividend amount, so it is equity instrument. Means when I am saying equity shares, so can I say the entity can deny both the payment of principal amount as well as the payment of dividend amount. Means dividend will be declared only when there is a profit. Even though there is a profit, we can deny it. Even though there is a profit, even though there is a sufficient profit, we can deny or not? We can deny. Correct. We will not deny because we are a good company, but we can deny or not. So it means entity has an unconditional right to refuse the payment, both principal and interest or dividend. It will be classified as what? Equity instrument. Correct. Then there is one third point. If the settlement of financial instrument, if the settlement of financial instrument is contingent, if the settlement of financial instrument is contingent on the outcome of circumstances which is beyond the control of either party, means right now on the date when we have issued such instrument, we don't know whether it will be equity settled or cash settled. So always it will be classified as what? financial liability. So initially it will be classified as what? Financial liability. Subsequently we can make it what? Subsequently we can make it what? Subsequently means on the date of settlement we can reclassify it as what? Equity instrument. But initially it will be always financial liability. Means when I am saying convertible debenture, when I am saying compulsory convertible debenture, so compulsory convertible debenture, there is no doubt it will be converted into equity shares. But when I am saying optionally convertible debenture, so there is an option given to the holder, either you can demand cash or you can demand equity shares. So right now it is contingent, which is not within the control of either party. This outcome is not within the control of either party. So on initial date, means on initial recognition, the principal amount will be classified as liability. Principal amount will be classified as liability. Understood? Yes, sir. So if the settlement of financial instrument is contingent on the outcome of circumstances which is beyond the control of either party, it will be initially always classified as what? Financial liability. Correct. Then coming to the accounting treatment of interest, dividend, gain, loss and transaction cost. So the rule is very simple. What is the rule? Any interest, any dividend, any gain, any loss related to financial liability will be always transferred to PL. Means any interest, any dividend, any gain, any loss. So right now can I say, when I am saying redeemable preference shares, when I am saying redeemable preference share, it is a financial liability or equity? It is a financial liability. So in that case, whatever dividend you are paying, that will be transferred to PL or retained earning? PL. So whatever is interest, dividend, gain or loss, whatever related to financial liability will be always transferred to PL. Same thing we have done in share-based payment. SBP liability, any reassessment gain or loss is always transferred to what? PL. Any reassessment gain or loss is always transferred to PL. Correct. But if there is a point number C, distribution to the holder of equity instrument, distribution of the holder to the equity instrument, any type of distribution to the holder of the equity instrument will be always transferred to retained earning. Dividend means dividend, equity dividend will be always transferred retained earning, it will never be transferred to PL. So distribution to the holder of equity instrument will be always recognized directly to equity, that is what? Retained earning. Correct. Now any transaction cost means when you have done contract, whatever transaction cost has been incurred. Correct. So transaction cost what Ind AS 32 says that will be deducted from the amount of financial liability and from the amount of equity instrument. Correct. So transaction cost of equity instrument or financial liability shall be deducted from the respective amount. So for example, underwriting commission paid on issue of equity shares. Underwriting commission paid, if you remember, bachpan mein we used to open one underwriting commission account. Now that accounting gone. Now whatever underwriting commission paid is a transaction cost. Underwriting commission amount will be deducted from the amount of either equity or from debenture. Debenture is a liability. So now it will be deducted from the respective amount. Will not open separate underwriting commission account. Are you able to understand? So underwriting commission can be an example of what? Transaction cost. Or any brokerage paid, whatever. Understood? Yes, sir. Correct. But any transaction costs that are related to compound financial instrument is the next topic. First, let us come to compound financial instrument. Compound financial instrument means what? Any financial instrument which have both characteristics, equity and liability, that become what? Compound financial instrument. The best example is convertible debenture, convertible preference shares. These are what? Compound financial instrument. So some portion will be liability, some portion will be equity, that become compound financial instrument. I hope you are understanding. So any compound financial instrument contain the element of both financial liability or equity instrument in a single contract. Now what Ind AS 32 says that for accounting purpose, we will split compound financial instrument two part, financial liability component and equity component. Now how to split that we need to understand. How to split that we need to understand. Correct now. Are you able to understand? Sorry. How to split. So what Ind AS 32 says that we need to split compound financial instrument. How to split that we need to understand. But first, before splitting Before splitting, let us take some example to understand whether the given instrument is a financial liability or equity instrument or compound financial instrument. Can you see in example from the information given in the question you will be able to understand the compound financial instrument, because if they say separate means compound financial instrument, means when a questions come and they are saying separated, so we'll separate only compound financial instrument now. So from the given question it is easily understood it is a compound financial instrument, but practically we need to understand whether it is a compound, it is not a compound. Are you getting what I am saying? So can you say given instrument for one entity, it can be either equity or financial liability or compound financial instrument. Means what I want to say, doubt is always in this case. Means doubt is not in case of financial asset. Means for one entity, if it is a financial asset, it is a financial asset. Doubt is coming यहाँ पर कि first whether it is a financial liability or equity. Now it can be compound also. If it is compound, splitting is required. If it is compound, splitting is required. For this entity, means for the issuer of the instrument, doubt will come. For holder, it is always financial asset. If I am saying debenture holders, मजा आ रहा है financial asset. But the entity who has issued the debenture, it may be liability, it may be equity, it may be what? Achha, debenture can be also equity. If I am saying, let me take when it can be equity, correct now? That depends upon the terms of the contract. That depends upon the terms of the contract. Means we need to apply the substance over the contract. Substance over the contract. Correct? Yes, sir. So what? Let me take. First, redeemable preference share with fixed per annum. What is the rule? Rule is what? First, find out principal component and interest or dividend component. Means rule is what? You need to identify two components, principal component and interest and dividend component. If there is an obligation to pay principal, an obligation to pay interest, means company cannot refuse it, so it become liability. If suppose company can deny principal amount, company can deny interest or dividend amount, it become equity. But suppose one can be denied but other cannot be denied, it become what? Compound. Rule is very simple. Rule is very simple. So first you need to identify two elements, two portion, I will say two portion of that instrument. Means every instrument have two portion, principal and interest or dividend. So first find out principal, find out whether the company can refuse it or company cannot refuse it. Interest, company can refuse it or company cannot refuse it. Understood? Let us take redeemable preference share with fixed dividend. You only say principal is redeemable, means company cannot refuse payment, and dividend you can see fixed dividend per annum. Fixed dividend per annum means company has an obligation to pay, it become what? Financial liability. Correct. Then non-redeemable preference shares. Non-redeemable preference shares means principal is what? Irredeemable. Company can refuse it. Correct. With cumulative and non-cumulative. My question to you, when I am saying cumulative or non-cumulative dividend at the discretion of issuer, they have given cumulative or non-cumulative at the discretion of issuer, means company can refuse it. Company can refuse both principal and dividend amount, therefore it become equity. Understood? Now can you read fast? Any doubt you can ask me or I will read on your behalf. You can also read now. Let me take one more example. Redeemable preference shares. Redeemable preference shares means principal amount there is an obligation to pay. Principal amount there is an obligation to pay. With cumulative or non-cumulative dividend at the discretion of issuer, means company can refuse dividend. Company can refuse dividend. It become compound financial instrument. It become compound financial instrument. Understood this point? Have you understood this point? अरे बोलना, yes बोल. Understanding? Not understanding. Point number 1 you understood. Point number 2 you understood. Point number 3, redeemable preference shares means company need to pay it. Redeemable na means there is company cannot refuse the payment of principal amount. But they say with cumulative or non-cumulative dividend at the discretion of issuer, means dividend can be given only when decided by entity. Issuer means company can deny what? Dividend. So one component is what? Liability. One component is what? Equity. It become what? Compound financial instrument. Can you apply this rule by your own? Because if I will say, maja nahi aayega. You need to think by your own. Any doubt we'll discuss. So can you read from Point number 4 to point number 16. Any doubt I will discuss. Read. Everyone live student also read every point. Any doubt we will discuss. Okay. Doubt will come. Doubt will come. I am just observing what point you are able to understand by your own, what point you are not able to understand by your own. Because already you have done this chapter now. You might have done detailed discussion. Correct? So only revision is going on. So doubt will come if you have forgotten some point. Correct? So you can ask me. One doubt has came that any court cases are also not in the hand of company. Why can't it be classed? Just try to understand court cases, whatever obligation will arise, that is not under a contract. Whether you have done any contract with the court that I will pay that amount. Any case, legal case is filed against you. So there might be some obligation in future due to some past event. So it is covered under India's 37. But it is not under a contract now. Whether it is under a contract that you will pay obligation to that party. Court cases is going on. So there is no contract, only the question of financial instrument will not arise. It might be contingent liability, it might be a provision, apply India's 37 requirement. India's 37. Understood? Have you understood? Point number 4, have you understood? Point number 4, non-redeemable preference shares with cumulative payable only on liquidation, and there is no contractual obligation exists to pay unless upon liquidation. Correct? Because non-redeemable means there is no obligation to pay principal amount, with cumulative dividend payable only on liquidation. Only on liquidation, and there is no contractual obligation exists to pay unless upon liquidation, means there is no obligation to pay. It means what is pure equity. Company can deny during the lifetime of the company. Company can deny, so it is not a liability, it is a equity, pure equity. Redeemable preference share with cumulative dividend. Dividend is payable only on liquidation, and there is no. So redeemable, the principal amount is what? Redeemable, there is an obligation to pay, but dividend amount, there is no obligation to pay, therefore it become compound financial instrument. Non-redeemable preference share, there is no obligation to pay principal amount, with cumulative dividend, and there is a contractual obligation exists to pay dividend, that entity does not have an unconditional right to defer payment. So can you say dividend they need to pay? They are saying cumulative dividend, and there is a contractual obligation exists to pay dividend, means company does not have an unconditional right to defer payment of dividend. Means can I say in this case dividend there is an obligation to pay, and principal amount there is no obligation to pay, it become compound financial instrument. I hope you are understanding. Redeemable preference share with cumulative dividend, and there is a contractual obligation exists to pay dividend, that entity does not have, so it is redeemable. Principal amount redeemable, dividend is also obligation to pay, therefore it become pure financial liability. Compulsory convertible preference share, compulsory convertible preference shares, so it will be converted into equity shares, so there is no obligation to pay any cash. or any other financial asset, means principal amount is what? Equity component with discretionary dividend, means company can deny dividend also. There is no obligation to pay dividend. It become pure equity. Pure equity. Compulsory convertible preference share with fixed dividend. Token is compulsory convertible preference share. Principal amount there is no obligation to pay, but dividend amount there is some obligation to pay. It become what? Compound financial instrument. I hope you are understanding. Redeemable debentures with fixed interest. Redeemable debenture, obligation to pay, fixed interest, obligation to pay. It become pure financial liability. Irredeemable debenture with fixed interest, debenture amount, principal amount, there is no obligation to pay, fixed interest, there is an obligation to pay. It become what? Compound financial instrument. Redeemable debenture with discretionary interest, both are, principal amount is what? There is an obligation to pay. Discretionary interest means company can deny interest, therefore it is what? Compound financial instrument. Irredeemable debenture with no guarantee of interest. Irredeemable debenture, principal amount no obligation with no guarantee of interest. Interest no obligation, therefore it become pure equity interest. Zero coupon bond or deep discount bond, means I hope you know about deep discount bond, which is issued on deep discount. But can you say in that case there is an obligation to pay? Obligation to pay means what? It is a financial liability. It is a financial liability. Correct. Optionally convertible redeemable debenture. Can you say when I am saying optionally convertible, whenever there is an option, some right is given. Correct. Whenever there is an option, so can you say we have given right? Nothing is free in India. So if I am giving you right, I will charge something from you or not. Are you getting? So suppose I have given a right to you that you can come in class and you can enjoy the class, and you have a right to cancel the class. You don't have right, huh? But suppose if I have given that right, you decide when I will take class, but I will charge the nominal fees or more fees? Higher fees. So whatever extra I am charging, that I am receiving, but for that I am not, there is no obligation to return that amount, na? So can I say whenever there is an option given, some amount is received and that there is no obligation to pay that amount. So whenever there is an option, it will be always about compound financial instrument. Means whenever there is some right attached, it will be always what? Compound financial instrument. Understood? So optionally convertible redeemable debenture, participating redeemable preference share. So we have given a right, even though you are redeemable preference share, but you can participate in surplus fund and surplus profit of the company. One right I have given to you. Whenever right, nothing is free in India. For right will charge some amount and there is no obligation to return that amount. So it become what? Compound financial instrument. Correct. So what I want to say, whenever there is a right, always it will be what? Compound financial instrument. Understood? Any doubt? Now in this all examples, if you have doubt, so I will repeat that example. So if you have any doubt, you can ask me. Explain point number 15, 16. Now I have explained. Any doubt in 15, 16? I have explained every point. 8, 9, 14, 15 also I have explained. After my explanation, any doubt? After my explanation, any doubt? I am waiting for your doubt. Cleared, sir. मजा आया? मजा आया? देखो, everyone is saying clear, sir, clear, sir, clear, sir. You have also understood? Huh? So what happened? Whenever the objective of this batch is what? Objective of this batch is what? After this batch, you should be able to score more than 60%. If you are not able to score more than 60%, the objective defeated. Objective defeated. Correct? So I am taking lot of pain. Means I am not skipping any point. I could have skipped this much examples because this all thing I do in what? Regular class also. Regular class I will be slow. Here I am fast. The difference is that. But I am not skipping any point. All India's whatever I have covered, I have skipped those. I will skip only those points which I know that cannot be asked in exam. But I have not skipped that much also. Means 1% will be that point that I'll skip. So what is the objective of this batch? First point, after my class, if you are not able to score more than 60%, objective defeated. But how you will score 60%? After this batch or during this batch, you need to also practice a lot of question by your own. If you think that by coming in class you will score more than 60%, impossible. Next to impossible. I will not give any wrong information to you right now. If you are saying, sir, I am coming in this batch, whether you will be able to score 60%, no. You need to practice a lot of question by your own. Revision I am doing, content I am saying, important question I am taking, but who will practice that? You will practice now. Understood? So what I want to say, please, because this is third day, now I need to say, first day, second day, I have not said anything, because it is quite possible that you need to understand my speed, whether it is okay or not okay, what is my process. Now you have understood my all emotions. Correct now? You have understood my emotions, you understood what I am going to teach, what I am not going to teach. So but once again I am saying, after this batch, if you are not able to score more than 60%, the objective defeated. And you can score more than 60% only when you practice a lot of questions by your own, but only those questions which is given by ICAI. There is no need to refer any book. Solve all questions of ICAI study material, RTP, MTP, more than 60% will come, that is my guarantee. There is no need to refer any reference book. Question is going to come from ICAI book. They will only change the number. And believe me, if question is coming from outside ICAI book, now don't worry. That question will be new to me also. If I'll give exam now, I will also die. So, nothing to worry now. Means if the question is new, it is new to everyone. If it is new to everyone, perform. If you perform, you will get marks. Are you able to understand? Yes, sir. Chalo. Very good. Someone is saying that he is listening the class after 3 years of coaching, then also he is able to understand. Is okay. Is after 3 years of gap, he is listening the classes, but he is able to understand. Means okay. Now coming to the next point, I will not waste much of your time. Correct. The next point is very important from examination point of view, how to split compound financial instrument. What I want to say, this type of question, normally they will not ask now. Means this is a case study based question. Means suppose in exam they will give first identify whether it is compound financial instrument, then split, then it becomes a CA final level question, but they don't give this type of question. They will say this is compound financial instrument, split it. So normally from exam point of view, when they say separate, so separate means what? Compound financial instrument to equity, which the instrument which is only equity, the instrument which is only financial liability, they will not say separate now. So from the question we'll understand it is a compound financial instrument. Now we need to know how to split. Splitting is very simple. How to split fair value of compound financial instrument means whatever proceed received, that become fair value of compound financial instrument. Correct? The proceed received is what? Fair value of compound financial instrument. Can you say proceed received means what? Nominal value plus premium minus discount. Proceed received means what? Nominal value plus premium minus discount. देखो, I have said plus premium minus discount. This is at the time of issue, at the time of redemption. Huh? At the time of issue, not at the time of redemption. Huh? Correct? And I have not deducted transaction cost. Don't deduct transaction cost. Don't deduct transaction cost. Don't deduct. Kasam khao. Don't deduct transaction cost. Means suppose 1 lakh nominal value issued at 10% discount and underwriting commission 2%. So what is the proceed? What is the proceed? Understood now? 1 lakh is the nominal value, 10% discount, underwriting commission 2%. What is the proceed? Proceed is what? I am not able to listen. Say loud na. 90,000. Correct only. 90,000 means transaction cost will not be considered. Transaction cost will not be considered. This is the area where students do mistake. They become bhavuk. Emotions. Emotionally affected in exam. Correct? Yes, sir. Now let's fair value of liability component. Fair value of liability component. Now you understood what is the liability component. Liability component means there is an obligation to pay. So identify where there is an obligation to pay. So we can find out contractual cash outflow. Contractual cash outflow means there is an obligation to pay. So we need to find out present value of contractual cash outflow discounted at current market rate of interest. Current market rate of interest of similar instrument without equity options, without equity conversion. Understood? So present value of contractual cash outflow discounted at market rate of interest of similar instrument without equity component. This become what? Liability component. Means can I say market rate of interest will be given in the question? Market rate of interest will be given in the question. If market rate of interest is not given in the question, question is not correct. It means question is not correct. Means without market rate of interest we can't proceed only. If market rate of interest is not given, so I will say question is not correct. So smart work, assume some market rate of interest. But don't panic in exam. It is a market rate of interest will be given in the question. It is, if not given, the question is wrong. The difference between these two will be what? Fair value of equity component. Let me take some questions. Come to questions. Of course, I will not be able to take entire question, but I will take some questions so that it will give you some idea. Okay. First question, question number 1. This is a question of my booklet, whatever I have provided. Okay. On 1st April 2007, A Limited issued 10 lakh 12% compulsory convertible debentures of face value of 100 per debenture at par. The debentures are convertible on 31st March 2011 into ordinary shares. The interest rate for equivalent debenture without conversion right would have been 14%. Being compound finance instrument, you are required to separate equity and debt portion as on 1/4/2007. You can see they have given compulsory convertible debenture with fixed interest. Compulsory convertible means there is no obligation to pay principal amount. The principal amount is equity or liability? Equity. But there is an obligation to pay fixed interest. So interest amount is what? Liability. Means can I say we can easily find out the contractual cash outflow. We call it CCO. CCO means what? Contractual cash outflow at the end of each year. So this is how many year? This is how many year they have said? It is 1/4/2007. It will be redeemed on 31st March 2011. So we need to find out each year end 8, 9, 10, 11. So can you see there is an interest outflow, interest outflow, interest outflow, interest outflow, no principal outflow. Principal outflow is 0. So this become contractual cash outflow. Now we'll discount it by using what? Market rate of interest given the question. What is the market rate of interest given the question? Acha. Can you see this interest is calculated by using contractual rate of interest. So what is the contractual rate of interest? 12%. 12% into 10 lakh is what? 1,20,000. Means when you are finding out cash outflow, you are using contractual rate of interest. When you are finding out cash outflow, that depends upon contract. You will use contractual rate of interest. Correct. Now discounting factor will be taken by using what? Market rate of interest. So we can find out present value by using what? Market rate of interest. This become present value. This become what? Fair value of liability component. What is the proceed received? It was neither issued at discount nor at premium. The nominal value become proceed received. The difference become what? Equity component. Understood. Means what journal entry you are doing on 1/4/2007? You only say. Bank account, how much you have received? 10 lakh. 2. 12% convertible debenture. Financial liability, how much? 3,49,656. To 12% convertible debenture equity instrument, how much? 6,50,000, 344. Can I say this will be shown under the head statement of changes in equity? Means this will be shown under statement of changes in equity, and this will be from a statement of changes in equity. It will go to other equity in the balance sheet. And can I say this can be either, this will be shown under financial liability, but it can be either current liability or non-current liability depending upon definition of Ind AS 1. Depending upon definition of Ind AS 1. Do you know when it will become current liability, when it will become non-current liability? However, can I say out of these, some component may be payable within 12 months, some component may be payable after 12 months. That you need to identify. The component which is payable within will be what? And which is payable after 12 months is what? Have you understood this much? Let me take one more question. So can I say Ind AS 32 discuss only about initial classification. Subsequent accounting is done as per Ind AS 109. Subsequent accounting will be done as per Ind AS 109. So right now I am teaching you Ind AS 32. Ind AS 32 discuss only what will be the initial journal entry for compound financial instrument, means how to split. Subsequent accounting will be done as per Ind AS 109, but I will take one question to discuss subsequent accounting for compound financial instrument also. Correct? Yes, sir. Come to question number 4. Given in this only. On 1st April 2008, A Limited issued 10 lakh 8% convertible debenture of face value of rupees 100 per debenture at a discount of 10%. What is the proceeds? 98, 99 lakh ray, 9 lakh. 90,000 how? 9 lakh. The debentures are redeemable at a premium of 10%. Redeemable at a premium of 10%. Will you consider for proceeds? It is redeemable. Means it is contractual cash outflow on 31st March 2011, or these may be converted into ordinary shares at the option of holder. What is given? Option is given. Whenever option is given, it is always what? Compound finance instrument. Now option is given means settlement is contingent on the outcome which is not within the control of either party. It means, can I say right now principal amount can be either converted into equity share or can be redeemed in cash, but initially it will be classified as financial liability or equity. So can you say principal amount will be initially classified as, because right now we don't know whether it will be converted into equity shares or it will be redeemed in cash. Contingent means initially classified as liability. On settlement it may become what? Equity. That we don't know. Right now. But what Ind AS says that because it is contingent, principal amount will be initially classified as liability, and of course there is a fixed interest, that is a liability only. So in this case principal amount and interest amount both are classified as liability. Now one doubt will come. So how it is compound? Doubt come because option has been given. Whenever option is given, some consideration will be received for the option. Just try to, there are 3 components यहाँ पर. One is option, one is principal, one is liability. Option is also given na? Are bolna re. So option means right is given. Then principal amount, then interest amount. Principal amount contingent, initially classified as liability. Interest is liability only. Option, whatever consideration you have received, whether there is an obligation to pay, there is no obligation to pay. So that we need to find out now how much consideration received for option, and then we retained by the entity forever. It become what? Equity. Understood? For principal right now we don't know. So initially it will be, subsequently it may become equity, or it may remain liability. Understood? Have you understood? Yes, sir. So can I say in this case, when you are finding contractual cash outflow, I will do this question on your behalf. What is the year end? What are the 31st March? Starting from which date? 2009 na? 2009, 10, 11. 3 years. Now we need to find out contractual cash outflow. What is the contractual rate of interest? 8%. 8% of 10 lakh, 80,000, 80,000, 80,000 plus principal amount. Principal amount will be initially classified as liability. But when it was compulsory convertible in the previous question, we have taken 0 because compulsory. In this question, optionally. Correct? Are you able to understand? What is the principal amount? 10 lakh redeemable at premium. It becomes 11 lakh. So contractual cash outflow, the maximum liability can be 11 lakh. Means what is the objective of India's? Identify maximum liability and minimum what? Equity. Same thing we have done in SBP with cash alternative. Maximum liability, minimum equity. Because we are conservative. If liability become equity, okay. But if equity become liability, that is danger. Are you getting what I am saying? Liability may become equity. Then to happiness now we'll celebrate Diwali. If the liability become equity, it is a celebration now. But if equity become liability, danger. So find out maximum liability from user point of view. Understood? This is the objective. Now we'll find out present value factor at what rate? 10%. 10% is what? 10% is what? Market rate of interest. Then we can find out present value. Can you give me present value from the solution only? What is the present value? Huh? What happened? Market rate of interest is what? It is 20%. Why you have said 10%? Discount is 10%. Nalayak. Read the question carefully. In class you are doing mistake. What you will do in exam? Oi. In class you are without pressure na. In exam you will be with lot of pressure. 20% na. Isliye I always say write and do. When we don't write, we do this type of mistake. Then we cry after exam. One mistake, 0 marks. One mistake, 0 marks. One mistake, 6 months. Simple na? This type of mistake are dangerous mistake. This is suicide. Suicide na? We know everything, then also we are doing mistake. Are bolna re. Kasam ka. Will not do this type of mistake. Read the question twice. Chalega? But what is the present value? 8 lakh. 8 lakh 5,000. What is the proceeds? 9 lakh. Very good. In this also I have seen student do mistake. Danger, danger, super danger. Super danger. I have seen student take 10 lakh. Because written in the question 10 lakh na. Are bolna re. Means you know proceeds. But I have seen in exam, because I have done lot of analysis of many answer sheet. After exam, many students will come to me, so where I have done mistake. I will say this is the mistake. There are sometimes ICAI don't give marks chalta hai. That I know. But this type of mistake, danger. I have seen proceed, they will take 10 lakh. They say nominal value, maja aa raha hai. Correct? How much the difference? Difference is what? 94, 918. Now with this question, if you have understood, I would like to explain some more point. Calculation understood? Splitting understood? Now I would like to explain some more point. Can I do subsequent accounting if you permit? Not asking this question, but can be asked na? Subsequent accounting. Means can I say we need to prepare 2 account? One is what? Everyone. One is financial liability account. Is what is the name of the instrument? It is 8% na? 8% optionally convertible debenture. We'll say financial liability. Let us prepare this account. Can you help me? Can you help me? Are bolna nahi? So we'll do 1/4/2007. By bank how much? Batao. By bank how much? 9 lakh. 9 lakh. 10 lakh, 9 lakh. देखो first you are doing mistake. अभी right now we have done one journal entry. Bank account debit to financial liability to equity instrument. So financial liability is 8,05,082. 8,05,082. Abhi right now I have given one journal entry. Previous question. What journal entry I have given? Bank account debit to financial liability to equity instrument. So financial liability account you are preparing na. So why you are saying 10 lakh? 10 lakh to maha is a 10 lakh. How 10 lakh came? How 10 lakh? You are into CA inter right now. वो CA इंटर में नॉमिनल वैल्यू करते थे. नाउ देयर इज नो कॉन्सेप्ट ऑफ नॉमिनल वैल्यू. कसम खाओ, देयर इज नो कॉन्सेप्ट ऑफ, कसम का कसम, देयर इज नो कॉन्सेप्ट ऑफ नॉमिनल वैल्यू. कसम, नॉट माई कसम, टू हुम यू लव, हाँ उसका कसम, हाँ अंडरस्टूड, एक्सेप्ट पेरेंट्स, हाँ ठीक है. नलायक. 8,05,082. I am here to just give you the area where you can do mistake. Understood this point? Now we recognize interest expense. Liability means interest expense. बोलना yes or no? So no need to see the solution. Solution नहीं देखना है. When you see the solution, no one will see the solution, huh? Because I am here to find out your mistake. So when you do by reading solution, you will not do mistake, na? Are you able to understand? There is no need to read solution. By interest, but how much? Interest how much? Means at what rate? At 8%? अरे बोलना रे. At 8%? Second mistake. Second mistake. You are saying 8%? Second mistake. First mistake you identify? अरे बोल. Second mistake. Write down somewhere. We are doing PAP. Second mistake na. You need to identify mistake, then rectify it na. You have done one chapter rectification of error in bachpan. First identify the error, then rectify it, then prepare balance sheet. So balance sheet we prepare in exam hall, huh? Right now we are identifying where we can do mistake. At what rate? At EIR. Oh, at effective interest rate. Kasam khao. Interest expense will be always calculated by applying EIR. I have not said market rate of interest, huh? I have not said market rate of interest. It is EIR. Means there are three rates of interest. One is contractual rate of interest, one is market rate of interest, one is EIR. But the contractual rate of interest is required only to calculate contractual outflow. Contractual rate of interest is always required to calculate only contractual outflow. Market rate of interest is required to calculate present value. Present value. And EIR is required to calculate interest expense. Oh my God. So there are three rates of interest. One is what? This is required to calculate contractual cash outflow. Contractual cash outflow. Then what is market rate of interest? This is required to calculate present value of contractual cash outflow. Then third is what? EIR. EIR is required to calculate interest expense. Kasam khaye? Now, whenever there is no transaction cost, EIR will be equal to what? Market rate of interest. If there is no transaction cost, means there can be some transaction cost also. Means suppose in this question I would have given underwriting commission. Suppose. Then EIR will be different than what? Market rate of interest. One question is already asked like this, huh? I will take that question also. Means interest expense is calculated by applying EIR. But whenever there is no transaction cost, EIR will be equal to market rate of interest. Thank you very much. There is no need to calculate EIR. Correct? Yes. So 20%. EIR is equal to 20%. EIR is equal to 20% in this question. Correct? Can you give interest expense now? मजा आ रहा है ना? बोलो. Please give me fast. One lakh 96,682. Then 31st March 2008. Can you see this will be to bank. To bank means contractual cash outflow. I don't have calculator यहाँ पे. I will only calculate. I will not ask you to calculate. हाँ. I will not ask you to calculate. How you can do mistake if you have calculator? 1 lakh 61,000. For solution I am dependent on you. Huh? Don't give me wrong amount. It is time wastage na. Okay? Okay? Yeah. Now to bank means contractual cash outflow. To bank means contractual cash outflow. What is the first year contractual cash outflow? 80,000. Then what is the balance? Carry it down. 8,86,09. Can you see this can be continued for second year and third year? Let us continue because only I will take one question. 1/4/2008 by balance brought down 8,86,098. 31st March 2009. Once again by interest at what rate? 20%. Can you give me? 1,77,220. Then 31st March 2009. To bank how much? 80,000. Correct. To balance carried down how much? 9,83,318. Correct. 1/4/2009 by balance brought down 9,83,318. Can I say last year interest will be taken as a balance sheet figure due to approximation difference? बचपन से we are taking last year interest as balance sheet figure. So this minus 11 lakh. 11 lakh na? 11,80,000. This minus 11,80,000 how much? What is the last contractual cash outflow? 11,80,000. 1 lakh how much? 682. But this will be approximately equal to 20% only. If you want to calculate 20%, approximately will be same amount. But we know that our contractual cash outflow is 11,80,000. So we should take the balance sheet figure only. Correct. Now can you say 31st March 2010 is settlement date? It is settlement date. Now debenture holder may offer cash settlement or equity settlement. Let us first assume cash settlement. Look at it, cash settlement means interest will be paid, bank 80,000. But principal will be also paid in cash. Principal also will paid in cash and this account will be closed. This account will be permanently closed if they settled in cash. If you remember, same thing we have done in SBP with cash alternative. Correct. Now coming to one more account. There is what? 8% optionally convertible debenture equity instrument. Can you see this account also will prepare? Only one question I am taking in detail, huh? Only one question I am taking in detail. Initial accounting, subsequent accounting, both I am doing. One question, everything, every concept I am giving. Then on 1/4/2007 by bank how much? By bank how much? 94,918. So this is the amount which we have received for option. Option means I have given right, so I have received this amount. This become equity. Now you only say whether we do subsequent measurement for equity. No. SBP reserve. No subsequent measurement of equity. Never. Never subsequent measurement of equity. Only subsequent measurement of financial asset, financial liability. Equity is only recognized initially with the amount of consideration received. no subsequent measurement. So can I say it balance will remain same? Can I say it will be 94918? Then once again it will be 94918. Once again it will be 94918. Are you able to understand? I am not writing anything. This 2 balance by balance, huh? Once again it will be 94918. But here, because already settled. So what India says that other equity will be transferred to equity. Other equity will be transferred to equity. India says on settlement, equity component will be transferred to equity. But due to Companies Act, equity means equity share capital at nominal value. India says it should be transferred to equity. But can we override the requirement of Companies Act? Companies Act says equity means equity share capital at nominal value. So we have not issued any equity shares. So because of Companies Act, we'll transfer it to retained earning. Otherwise, as per India's, it should be transferred to what? Equity. I said na, India's, as per India's, there are two parts, equity and other equity. But because of Companies Act, in Schedule 3, they have given equity share capital at nominal value. Bakwas concept. 100% there is some amendment going to come in Schedule 3. Till now, the amendment has not been done. Because if that is amended, entire Companies Act need to be amended. Securities premium, that proviso need to be cancelled. Are you getting what I am saying? So we'll say transfer to retained earning. Thank you very much. Have you understood this point? Correct. If suppose on settlement equity settled, if suppose debenture holder opted for equity, same thing whatever we have done in SBP with cash alternative. So I am just doing last year accounting. If suppose they have opted for what? Equity conversion. So what was my liability? It was 9,83,318. I am doing last year accounting, financial liability. 9,83,318. This was by balance brought down. Last year, year 3, Then we'll say interest. Interest was how much? 19,682. Then can I say there is a contractual obligation to pay interest component? So 80,000 will be paid. But now we'll say what? 2 equity share capital and the balancing figure will be transferred to securities premium. This journal entry we are doing as per Companies Act. However, India says it will be transferred to equity. Correct now? Because of Companies Act, we need to write down what? Equity share capital and securities premium. So in this, no, actually I have not given the number of equity shares in the question. Suppose number of equity shares is 1 lakh. Suppose, let us assume. So this will be 1 lakh into 10. It become 10 lakh. And you can see the difference coming how much? How much difference? Exact 1 lakh. 1 lakh, yes, 1 lakh only. Understood? This is because of Companies Act. India is silent regarding premium component. Have you understood this journal entry? And then can I say equity component will be transferred to retained earning. Equity component, whatever is consideration received, will be transferred to retained earning. Have you understood? I think with this subsequent accounting also you have understood. So sometime they may ask splitting with subsequent accounting. Understood? So what this subsequent accounting we have done, this subsequent accounting of financial liability we have done as per Ind AS 109. So this we have done as per Ind AS 109. Ind AS 109 says that financial liability will be subsequently recognized by applying, it will be subsequently measured at amortized cost by applying EIR. Ind AS 109 says it will be subsequently measured at amortized cost by applying EIR. So this closing balance is known as amortized cost. Closing balance is known as amortized cost. So what Ind AS 109 says that financial liability is subsequently measured at amortized cost by applying EIR. In this question, EIR is equal to market rate of interest. Why it is equal to market rate of interest? Because there was no transaction cost. If there is a transaction cost, market rate of interest and EIR will be different. Understood? Any doubt? If you have not understood any point, you can ask me now. Concept over. My job done. I will take one more question, but my job done. Any doubt? I am giving you 2 minutes. If you have doubt, you can ask me. Coming to you. Alright, I will come to EIR calculation, don't worry. In this question, you have understood. Now he is asking how to calculate EIR. Let me come to other point. I will explain you. I am not asking. I will explain you how to calculate EIR. Don't be confused. I am coming to EIR wala point. No. There may be a question of compound instrument. There may not be a question of compound finance instrument. Don't make a trend in exam. Someone is asking, sir, whether there will be pakka one question of compound finance instrument. I will say don't make any trend in exam. If you go with the trend and suppose the trend changes, you suffer in exam hall. Don't make a trend. ICAI is there to change the trend. Understood? Correct? So don't make a trend, please. It may become, it may not come. Now I am coming to your doubt. One doubt has been asked. Now what is your doubt? You said that why it is a compound finance instrument. I said in this there are principal. There is a settlement option. Whenever settlement option, principal amount will be classified as liability initially. And there is a fixed interest. So that will be also liability. Then I have only said, now you will have doubt, it is not a compound financial instrument. So I said whenever option is given, the right is given now. So for the right some consideration you receive. But whatever consideration you are receiving for that right, there is no obligation to pay that consideration. Suppose you have taken classes from me, suppose regular batch. So my fees is 10,000. So you paid me 10,000. So I have an obligation to provide services to you for 10,000. But you say, sir, I want right. I said, take right. What is the right? You want to cancel the class as per your choice. So I have given right. So I will charge additional 40,000 for that. You know. Ask me that right. I will say your fees is 50,000. Correct? Now you can cancel. But can I say for that 40,000, whether I need to provide any services to you? No. There is no obligation to provide services to you. Means it is with me forever. So whenever right is given, some consideration is received. But there is no obligation to pay that consideration. Therefore, that whatever consideration you have received, that is equity or not. And therefore, it becomes what? Compound financial instrument. Now understood? Correct? Now understood? Yes, sir. Chalo. So I am assuming that you have understood one question. Intensely I have taken this question so that all the points are covered. Correct. Now let me take one question which is super question of ICAI. Already asked in exam, can be asked again in exam. Correct. Question number 8. ABC company issued 10,000 compulsory cumulative preference shares as on 1st April 2001 at a rate of 150s. You can see they have given compulsory, compulsory means there is no obligation to pay. Cumulative dividend. Now cumulative, doubt will come. Whenever there is a cumulative dividend, either it can be at the discretion of entity or it may be mandatory also. It may be mandatory also. Now just try to understand. Whenever we are in exam, we should write answer from examination point of view or from your imagination point of view. Means just try to, now cumulative dividend, it can be either at the discretion of entity. If you assume it is at the discretion of entity, it become what? Equity. Now the no splitting, bye bye. But at the end, what they have asked? Calculate the value of liability equity. But what you should assume? Means you should assume the cumulative dividend is mandatory. Now if you assume cumulative dividend is not mandatory, company can deny, so it become equity instrument. If it become equity instrument, then no splitting. Then you say, sir, this is no splitting required, 0 marks. You need to write as per the requirement of exam. If you have doubt, give both the answer. Don't give one answer now. Understood? So they have said cumulative dividend. So cumulative dividend can be either mandatory or it can be either at a discretion of entity. I will say whenever there is a question of what? Compound financial instrument, always assume it is mandatory. And is given also with second point you will understand the feeling of the question. They said the rate of dividend is 10% payable every year. But what does it mean? The rate of dividend is 10% payable every year. It means what? Payable every year mandatory na. So I think from this point also clear. But can you fight with the question? If you fight with the question, you will suffer. Understood? Correct. The preference shares are convertible into 5,000 equity shares of the company at the end of 5th year. Can you say number of equity shares issued is not relevant at the time of splitting? Number of shares which are going to be issued is not relevant at the time of splitting. At the time of splitting. But can you say this is fixed number of equity shares? Fixed number of equity shares. Correct? Understood? Now you might have done one point, fixed number of equity shares, variable number of equity shares you have done. If you have done this point, I will discuss at the end, not now. So don't be confused. If variable, then what will happen? Don't ask me that question right now. Correct? It is a fixed number of equity shares. From the date of allotment, when CCCPS are issued, the prevailing market rate of similar debenture without conversion option is 15% per annum. This is what? Market rate of interest. Transaction cost on the date of issuance is what? 2%. My question to you all, in this case, EIR will be equal to what? 15%. 13%. What is 13%? 50 minus 2. ER is not given. It means we need to calculate. But ER is not equal to, that you need to say, sir, ER is not equal to market rate of interest. So in this question, contractual rate of interest is what? 10%. Market rate of interest is what? ER. Normally in exam, 99% if there is a ER, they will give ER also. From examination point of view. But if not given, I will inform you how to calculate. You can see, read the question, they have given EIR also. 15.86%. Check karo. At the end, they have given EIR. Understood? Jabardast question. Now, if you are not conceptually strong, you will do mistake. You will be confused what to do about market rate of interest. What is EIR? What is contractual rate of interest? Normally, students do not understand this. But the contractual rate of interest is required for what? To calculate contractual cash outflow. Market rate of interest is required for what? present value, and ER is required to calculate amortized cost. Now you understand amortized cost by applying EIR. Understood? Correct? I think Jabardast question. Can we do this question? Can we do this question if you permit? I will do. Is that this is the question? So can you say in this question what is the nominal value? Always in exam write down this. If you have an habit of writing down this now, you will never do mistake. What is the nominal value? What is nominal value? 15 lakh. What is the contractual rate of interest? What is the market rate of interest? What is the contractual cash outflow? Can we find out? Dividend at the end of first year 1 lakh 50. Dividend at the end of second year 1 lakh 50. Dividend at the end of third year 1 lakh 50. Dividend at the end of fourth year 1 lakh 50. Dividend at the end of fifth year 1 lakh 50. Principal component, can I say it will be 0? Why 0? Because it is compulsory convertible. Correct. Then what is the transaction cost? 2% of what? 2% of 15 means 2% of proceeds. Yeah, no discount, no premium. Proceed is equal to nominal value. Correct? So it is 15 lakh. So it is equal to what? 30,000. So it means whenever transaction cost, you should think about EIR. EIR given how much? 15.86%. Understood? If you write down this much now, you will never do mistake. If you don't write and do now, you will do mistake. So it means there are 3 rate of interest: 10%, 15% and 15.86%. Now, first calculate what? Liability component. What is the proceed received? We need to find out fair value of liability component, that is present value of contractual cash outflow, discounted at what rate? 15%. So it is 1,50,000 multiplied by annuity factor at the rate of 15%. You can calculate easily. This become present value. This become fair value of liability component. Correct. So just try to understand. Transaction cost is not considered for splitting. Means proceed is what? Proceed is what? Nominal value plus premium minus discount, but not minus transaction cost. Shouldn't do mistake यहाँ पर भी. Transaction cost also deducted. So what India 32 says that in case of compound finance instrument, transaction cost will be allocated to liability component and equity component in the ratio of their fair value. It means first you need to calculate fair value of liability component and then do allocation of what? Transaction cost. So in this second point will be allocation of what? Transaction cost. How to allocate? You need to find out liability component, you need to find out equity component, then you need to find out fair value already calculated, then you need to find out transaction cost is 30,000. This will be allocated in this ratio, and transaction cost of respective component will be deducted from respective amount. So you can see this become net proceed. So this become net proceed, this amount and this amount means what is my journal entry? Bank account debit to financial liability equity instrument with net amount. Will not recognize transaction cost separately in the journal entry. Means my journal entry is what? Journal entry is what? I have not given. Bank account debit to financial liability to equity instrument with what amount? With the net amount. Means bank amount will be 14,70,000 net of transaction cost. Net of transaction cost. Now because can you say we are recognizing net proceed as liability, so can you say we need to calculate EIR. What is the meaning of ER now? I need to explain. ER means the discount rate at which present value of contractual cash outflow will be equal to net profit. ER means what? The rate of discount at which present value of contractual cash outflow will be equal to net profit. Means if there is no transaction cost, can I say the net profit will be this amount only, and then the rate of discount will be equal to market rate of interest. But in this case, the net amount become after transaction cost. Therefore, can I say we need to calculate EIR? We need to calculate EIR. And if suppose they have not given EIR, we can calculate EIR by using the concept of IRR. By using the concept of IRR. Understood? Have you understood this point? Correct. Now, normally in exam they don't ask the ledger account. They ask you to calculate what interest, expense and amortized cost. So can you say we can prepare this table, year end, opening liability, interest by applying what? EIR. EIR will be equal to 15.86%. Then contractual cash outflow, then closing liability. Can I say this to bachpan se we know? Opening balance is what? Opening balance amount is what? Opening liability? Opening liability is what? Which amount? 4,92,767. You can see we have taken 4,92,767. Interest by applying EIR, then minus 1,50,000. This will become amortized cost of first year. Then we'll do subsequently. We can calculate amortized cost of subsequent year. So normally they ask in exam this statement. This too we can prepare by. But normally student do mistake at EIR. Suppose in this question EIR is not given, then how to calculate EIR? I have given that also. Calculation of EIR if not given in the question. Suppose 99% they will give EIR, but 1% chance is there they have not given EIR. It means we need to calculate it. So how to calculate EIR? By using IRR concept. You know IRR? Correct. So EIR is the rate of interest at which present value of contractual cash outflow will be equal to what? Net profit. Let us first calculate present value at 15%. Can the present value of 15% already be calculated? Already we calculated 5,02,823. But our net profit is how much? 4,92,767. Means if you want to match this, you need to increase rate of interest. You need to increase it na. You know IRR na. So if 15% that amount is not coming, you want lower present value, will increase the rate of interest. So we'll first then find out present value of contractual cash outflow at 16%. Let us assume it can be 20% also, but let's get more accuracy. Now at 16% it is coming what? 4,91,100. Now apply the formula of IRR. ER is equal to 15% plus present value at 15% minus net profit divided by present value at 15% minus present value at 16%, multiply difference between the two rates. This formula to bachpan se you know. Apply that. Same amount will come 15.86%. Understood? Have you understood this entire question? Have you understood? If you want to write down this much, write down. If you want to write down this much, because this is not given the solution. So if EIR is not given, how to calculate EIR? Done? So I hope Now you have understood compound finance instrument. I have taken 3 questions. I think doubt over. You want to write down? Write down, write down. I hope you have understood how to calculate. Yeah, yeah. Yeah, yeah. If you know, apply that. I am not teaching you FM or SFM. If you know any other method, apply that. हाँ तो you apply that ना. There are 2 more method. I am not teaching you FM, SFM. I am teaching you FR. In FR 99% they will give what? EIR. I have just given you that how to calculate EIR by using the concept of IRR. If you know any other method, apply that. Your answer should be what? 15.86. Chalega? Because I am not teaching you FM, SFM now. If I would have been that teacher, I would have given 2 more method. I know, but I will not give. This time. This is not my job. Okay? Okay. Now, point number 3, early settlement. This is also very important from examination point of view. Normally, they ask question on this. Early settlement. Now, just try to understand what they say. Suppose there is a compound financial instrument and there is an early settlement for that. Then what will be done? Early settlement. Means right now we have done one question of optionally converted debenture. So, it will be settled as per what? Contract. But suppose there is an early settlement before contractual date. So how to do accounting for that? Once again I will take one question. From that question I will explain. Let me take one question. One very good question is there. Normally that questions is asked in exam. Come to next question. Question number 12. On 1st Jan 1999, A Limited issued 10% convertible debenture with face value of rupees 1000 maturing on 31st December 2008. The debentures is convertible into equity shares of A Limited at a conversion price of 25 per share. A conversion price of 25 per share. This is not relevant for splitting the issue. Splitting the instrument. Right. This is on the date of conversion. On the date of conversion, but can I say they have given conversion, so it means it is a fixed number of equity shares. Fixed number of equity shares because they have given conversion price. Okay. I'm just identifying because I hope you might be knowing about fixed number, variable number equity shares that we'll discuss at the end. Okay. Interest is payable half yearly. At the date of issue, A Limited could have issued non-convertible debt with a 10-year term being a coupon interest rate of 11%. First para you understood? Okay, first para is similar to whatever we have done till now. Whatever we have done till now. But in this question, one very interesting point, interest is payable half yearly. Means compounded half yearly. Are you able to understand what I am saying? Half yearly means this will become 5%. And can I say this will become 5.5%? Means present value need to be calculated by applying 5.5%. There is no transaction cost given. Thank you very much. Transaction cost not given, then EIR will be equal to market rate of interest. समझ में आ रहा है? Now one doubt will come. बताओ, is it a compulsory convertible or optionally convertible? Compulsory. Everyone. Listen. First, compulsory convertible is also compound. Optionally convertible is also compound because interest is fixed. But can it compulsory convertible? The principal amount will be 0 initially for calculating financial liability. Optionally convertible, the principal amount will not be 0. That will be initially classified as financial liability. This is the difference between compulsory and optionally. Both are compound only. So my question to you, when you are reading the question, what do you think? It is compulsory or optionally? What do you think? It is compulsory or optionally? अरे बोल, either say compulsory or say optionally. Compulsory, compulsory or optionally? Optionally. How you understood optionally? Huh? At the date of issue, A Limited could have issued non-convertible debt. Means non-convertible debt means what? Without any conversion option. Without any conversion option. Conversion option can be compulsory optionally. But non-convertible debt means it is without conversion option. It can be optionally, it can be compulsory. It is not clear with that, na? This question is not clear. Means prima facie it will look it is compulsory. Prima facie from my point of view it is compulsory only. I don't understand how you are saying optionally. Because in live class also some of them are saying optionally. Jadoo hai, batao. How you can say it is optionally? Whether question has given option is with the holder. No, question is not clear, na? They are saying, what they have said? Convertible debenture, the debenture is converted into equity share. Option to diya hi nahi hai, there is no option. Means prima facie it looks what? Compulsory. But ICAI solution is what? Optionally. What to do? Batao. What to do? We should say take compulsory or optionally. Now the optionally. Because we need to go as per ICAI solution. Correct now? So we'll make a rule. Whenever question is not clear, we'll always assume what? Optional. Means in this question they have not mentioned compulsory. In this question they have not mentioned optionally. So whenever question is not clear, we'll assume what? Optionally by giving a note from examination point of view. Can we make a rule? Whenever question is not clear, are you able to understand what I am saying? Because no compulsory is written, no optional is written. We'll always assume what? Optionally from examination point of view. Otherwise we'll die, na? But can you say we could have also assumed compulsory also? Got it? Understood? Yes, sir. Now what they have said, on 1st Jan 2004, the convertible debenture has a fair value of 1700. A Limited make a tender offer to the holder to the debenture to repurchase the debenture for rupees 1700, which the holder accept. At the date of repurchase, A Limited could have issued non-convertible debt with a 5-year term of bearing interest 8%. So how the entity account for equity and liability at the inception and at a repurchase of convertible instrument? Means can I say early settlement? Initially it was 10 year, but after 5 years they repurchase. So it means now they have marked the journal entry of repurchase also. Correct? Have you understood what is the question? Question, have you understood? Means this is the question. Means on 1/1/2019, fair value was 1000, contractual rate of interest 10%, market rate of interest 11%, ER is equal to 11%, correct? Can you see interest will be what? 1000 into 5%, 5% why? Half yearly. So can you see it is 5 year but 10 half year? This is 5 year but 10 half year? Means it 20 half year? Means when you are calculating present value, you should calculate present value for 10 year or 20 half year? 20 half year, discounted at which rate? Discounted at present value you want 10% or 11%? With 10%. 10%, 11%. But 11% divided by 2. 5.5%. It will become 5.5%. This will become 5%. Now can you say first splitting we can do? Splitting let us do. Splitting is what? Can I say calculation of what? Fair value of equity covenant, liability covenant on inception date. Are bolna re? So what is the proceed received? Proceed received is 1000. 1000 less fair value of liability component. Fair value of liability component means present value of interest component. Interest component means 50 will be discounted by taking 5.5% for 20 half year. 20 half year. This amount will come. This, you can do it. Okay? No need to calculate. This you can do it, provided you have calculator. This you can do it, provided you have calculator. Chalega? Then can I say present value principal amount? Why we have taken principal amount? Because we have taken optionally convertible. We have assumed optionally convertible. The principal amount is 1000. 1000 discounted at what, 5.5% at 20 half year. This will be this present value factor. This will be 342.7. This become total present value. This become fair value of liability component. This minus this will be what? Equity component. Understood? Now can you say equity component remains same every year? There is no subsequent measurement of equity component. Can I say this will be carried at amortized cost by applying? This 940 will be carried at amortized cost at the end of each year by applying? Yeah, what is ER? 11%. Means 5.5%. Because now discounting you have done at the end of half year. So you will add interest also at the end of each half year. Correct? Now coming to early settlement. Now just try to understand what actually happened. After 5 years on this date, they want to repurchase at rupees 700. So can you see this become fair value of compound financial instrument? Means they want to repurchase compound financial instrument now. So can you say after 5 years this become what? Fair value of compound financial instrument. Fair value of compound financial instrument means can you say now if I say again you split it into a liability and equity component, just try to understand. If I say this is the fair value as on this date and I said again you split it in liability and equity component, my question to you on, you will take market rate of interest, but on which date? On this date now, and they have given market rate of interest on this date is 8%. Can I say market rate, everyone? So no, the question, everything written that only. If the market rate of interest will decrease, can I say present value will increase? And therefore 1000 become what? 1700. Means now you can split and you can find out that this whatever consideration is paid by entity, how much consideration is paid for equity component and how much consideration is paid for liability component. So can you see if you know how much consideration paid for liability component and you can also calculate carrying amount of liability component, so consideration paid and carrying amount, can difference will be gain or loss on repurchase? Means can you say on repurchase date first you split the fair value of consideration paid by applying the same rule, then find out carrying amount of liability component by applying amortization cost, by applying EIR, and carrying amount of equity component remains same. Carrying amount of equity component remain same 60. So can I say on concentrate, don't look anything. Can I say on repurchase date first we'll calculate fair value of liability component and equity component on 1/1/2004. What is the fair value? 1700. Can we split the same rule? Now what is the remaining half year? 10 remaining half year. So can I say present value of liability means if you want to calculate fair value of liability component, it will be equal to present value of remaining contractual cash outflow discounted at 8% per annum, means 4% half year. Correct? You can see we have done the present value of interest component 50, but it is 4% for 10 half year. Similarly, principal component 1000, we have calculated present value factor at a rate of 4% for 10 half year. This will be what? Fair value of liability component. The difference will be fair value of equity component. Means how much you have paid for liability component. Means you have repurchased, you have done buyback now. Buyback means you have paid consideration. So how much consideration paid for liability component? 1081. How much consideration paid for equity component? On repurchase date. Now this will be compared with what? Carrying amount. You need to find out carrying amount of liability component by applying amortization cost. So we have just calculated carrying amount, just see. Correct. Now calculation of carrying amount of liability component, just try to understand. They say there are two ways of calculating carrying amount of liability component. Either you add interest and minus contractual cash outflow. Can you see you can get this amount? Means what is the amortization cost table? Opening balance plus interest by applying EIR minus contractual cash outflow. That will be what? Amortized cost. If you do for what? How many half year? 10 half year. So at the end of first 10 half year, you will get what? Amortized cost. That become carrying amount of liability component. Or can I say, we could have done in this way also. If I will calculate present value of remaining contractual cash outflow discounted at original EIR, means 5.5%, same answer will come or not? This is FM. By compounding or discounting, same answer will come or not? If you are compounding it and here say you are discounting it, same amount will come or not? Yes, discounting is more easy than compounding if the number of year is high. So to make it simple, can we say in this way? The calculation of carrying amount will be present value of remaining contractual cash outflow discounted at original EIR. What was the original EIR? 5.5%. So if you calculate present value, means 50 into present value at 5.5% for remaining 10 half year and 1000 into present value factor at the rate of 5.5% for 10 half year, can you see you will get the carrying amount? This 962 is the carrying amount of liability component and this 60 is the carrying amount of equity component. Total carrying amount become 1022. Then we can find out gain or loss. Liability component, how much consideration paid? Already calculated. Fair value. How much consideration paid for equity component? Fair value. Carrying amount. This become what? Gain or loss. Now what is the rule? Gain or loss of liability component will be transferred to PL or retained earning? PL. Gain or loss of equity component will remain in equity. This is the concept. Means what journal entry you'll do on repurchase. For repurchase journal entry, 10% finance, 10% is financial liability account debit to bank. This is carrying amount. This is consideration paid. The difference will be transferred to what? PL. And on repurchase of equity component, equity instrument carrying amount to bank, the difference will be transferred to other equity. Means retained earning, you can say. Other equity means retained earning or any other reserve and surplus, whatever your choice. Understood? Super important question from exam point of view. Have you understood this point? Any doubt? Calculation practice you do by your own. I am just giving you concept. I hope you have understood. Let us read what is given. Early settlement. When an entity extinguishes a convertible instrument before maturity through an early redemption or repurchase, entity allocate the consideration paid and any transaction cost for repurchase or redemption of the liability and equity component at the date of transaction. In other words, the issuer allocate consideration paid means 1700. Consideration paid means 1700 into liability component. Fair value of remaining contractual cash outflow using the discount rate that is based on market rate of interest on settlement date means 8%, and equity component will be equal to fair value of compound finance instrument means consideration paid means 700 minus fair value of liability component, whatever we have calculated, that is only given. Accounting treatment of gain or loss. The amount of gain or loss relating to liability component is recognized in PL. The amount of consideration relating to equity component is recognized in equity. Over. Compound financial instrument done. Correct. We'll take a 5-minute break. Hello. Kida? Chal. Can we start once again, everyone? Now, before break, we discussed compound finance instrument. Now, this chapter I have divided into many small topics. So, my suggestion is that when you are doing revision, you do revision topic wise. First, we have the meaning, topic number 1, meaning over, one chapter completed. Think in this way. Topic number 2, compound finance instrument, that topic over, one chapter completed. Think in this way. So when you do small bits, it become more interesting. If you think entire chapter as one chapter, entire topic as one chapter, it will be thoda sa difficult to revise. Topic number 1 done, topic number 2 done, topic number 3 is chapter number 3. Think in this way. Correct. So a small topic will come. So now the next topic is what you can see, recognition and measurement of financial asset. Correct. Now for recognition and measurement of financial asset, Ind AS 109 is applicable. So Ind AS 32 has given only meaning of financial asset. Initial and subsequent recognition of financial asset is covered under Ind AS 109. Now for the purpose of recognition measurement, all financial assets are classified into how many categories? 3 categories. Correct. So financial assets are classified into 3 categories. They said financial asset measured at amortized cost, measured at FBTOCI and measured at FBTPL. So financial asset measured at amortized cost. Now I hope you have understood what is the amortized cost. Amortized cost means by applying EIR. Correct. Second, financial asset measured at FBTOCI means in this case the any gain means it will be subsequently NAC recognized fair value, and any increase or decrease in fair value will be transferred to OCI. When we say fair value through PL, then any fair value gain or loss subsequently will be transferred to PL. This is the difference between what? This is the difference between OCI and PL. So financial asset measured at amortized cost, financial asset measured at FBTOCI, financial asset measured at FBTPL. Correct? Now, normally from examination point of view, it is not important, means normally they don't ask which financial asset will be amortized cost, which financial asset will be FBTOCI. From examination point of view, that is not relevant, because they till now they have not asked that type of question. Normally they will ask accounting treatment. For accounting treatment, can I say they will give you whether it is amortized cost, FBTPL or FBTOCI. However, from examination point of view, AC is more important, amortized cost is more important. We still know whatever question has been given ICAI study made, that is also related to what? Amortized cost. Means from examination point of view, if I will concentrate on AC, ho jata. But let us do some discussion. When a financial asset will become amortized cost, FBT or FBTOCI. For this purpose, what Ind AS says that classification will be based on 2 characteristics. First is known as contractual cash flow characteristics of financial asset. Contractual cash flow characteristics. So what they say, either the contractual cash means financial asset, either the financial asset will represent contractual cash flow, which will be solely the payment of principal or interest amount. For example, when I say investment debenture, okay, investment debenture will represent contractual cash flow, which will be solely the payment of principal and interest amount. So when we say contractual cash flow, it will have 2 components, principal component and interest component. For liability, it will be outflow. For asset, it will be inflow. For financial liability, it was a contractual cash outflow. We have done in compound financial instrument contractual cash outflow. For financial asset, it will be contractual cash inflow. That is the difference. Correct. Then there will be some financial asset which will not represent contractual cash flow, which will not represent contractual cash flow. For example, when I say investment equity shares, it will not represent any contractual cash inflow. So there will be some financial asset which will represent contractual cash flow. There will be some financial asset which will not represent contractual cash outflow. That you need to identify. Then second characteristics in which this classification depend is depending upon the business model. Okay, what is the entity's business model? Means for which purpose it was purchased. So there are three business model. First is hold to collect contractual cash flow till maturity. Means you will hold that financial asset till maturity. Second, hold to collect contractual cash flow and sell whenever required. Means you will hold it, but whenever required you will sell it. That will be second. And third, it will be held for the purpose of trading. When I say held for the purpose of trading, it means there is the intention to make some short-term profit. There is the intention to make some short-term profit. You purchase at rupees 100, price will increase, you will sell it. So there is the intention to make some short-term profit. Then it is held for the purpose of trading. Now, just try to understand what India says that now classification will depend upon whether that financial asset is equity instrument or debt instrument or derivative instrument. Means for classification, just try to understand what they said. Means any financial asset can be equity instrument of other entity, can be debt instrument of other entity, or can be derivative instrument of other entity. Derivative. The last one is what? Derivative. Means if you see definition, this is definition point number B. Equity instrument. This is definition point number C. And this is definition point number D. Point number A was cash. For cash, there is no subsequent or initial recognition. Cash means what? Cash. Cash means cash now. Cash means cash. Okay. So for that, no recognition principle required. Means they have given recognition, means when to classify the financial asset, that will be based on what is the nature of financial asset, whether it is equity instrument, whether it is debt instrument, whether it is derivative instrument. So for that purpose, they have given some analysis. So for debt instrument, what they said, first apply CCFC test. CCFC test means contractual cash flow characteristic test. If that is not fulfilled, means if there is no contractual cash flow, debt instrument, so can you say then it is held for the purpose of trading. If it is held for the purpose of trading, it will be measured FBTPL. Correct. But if suppose the contractual cash flow characteristic is fulfilled, if suppose contractual cash flow characteristic is fulfilled, then to apply the business model test. So can you say either it is hold to collect contractual cash flow till maturity. If it is hold to collect contractual cash flow till maturity, then it will be what? Amortized cost. And condition number 2, if suppose condition number 1 not satisfied, then we'll go to condition number 2. Then we'll find out whether it is hold to collect contractual cash flow and sale whenever required. Okay, sale whenever required means there is an intention to earn interest as well as sell it. Means there is an intention to earn some profit on sale also. Then also we say a sale whenever required. So this will be FBTOCI. Then it will be classified as what? FBTOCI. And third, what they have given one option. Suppose neither condition 1 satisfied nor condition 2 satisfied, or an option has been given to the entity that in initial recognition, entity can offer FBTPL for any financial asset. This option has been given. If for any financial asset you can offer which category? FBTPL category. But that option is irrevocable. Once this option is exercised, that financial asset need to be classified as FBTPL from the beginning, means it cannot be reclassified then. It cannot be reclassified. So that option is also available FBTPL. I hope you have understood. However, this is not important from examination point of view because they are not asking this type of question. If they will ask this type of question, they want to kill you. They want to kill you because this will be case study based question. Normally they are not asking case study based question. They are asking calculation based question. Calculation based question is always easier than case study based question. Correct? Yes, sir. Then coming to equity instrument, can you say equity instrument there is no contractual cash flow characteristics? So there is no contractual cash flow characteristics. Then first question will ask whether it is held for the purpose of trading. Can normally equity instrument are held for the purpose of trading? Normally. Correct. So if it is held for the purpose of trading, then it will be yes, and it will be measured at FBTPL. If no, then option has been given. Meaning if it is not held for the held for the purpose of trading, then option has been given to the entity, and that option is also irrevocable. What is that option? Either you can measure FBTOCI or FBTPL. That option has been given. Means entity option their choice. Correct. So if it is not held for the purpose of trading, either entity can go for FBTOCI option or FBTPL option. This point have you understood? Now third, if it is derivative instrument, so derivative instrument are always held for the purpose of trading. Derivative instrument are always held for the purpose of trading. It will be always what? FBTPL. Correct. Have you understood this point? Means can I say, just try to understand. If I just want to give you some what analysis, just try to understand. When I am saying AC, when I say debt instrument can be AC, correct, but equity instrument and derivative instrument cannot be AC. Means can I say only debt instrument can be classified as AC? Correct. When I am saying FBTOCI, so can I say only debt instrument and equity instrument can be classified as FBTOCI? When I am saying FBTPL, so can I say debt instrument, equity instrument and derivative instrument all can be classified as what? FBTPL. Understood? But if you see, when I am saying FBTOCI, for debt instrument it is with recycling, and for equity instrument it is without recycling. With recycling means what? Any cumulative gain or loss will be recycled to PL on derecognition. Means can I say, when I am saying FBTOCI, the fair value gain or loss will be transferred to OCI. So on derecognition, that cumulative gain or loss will be transferred to what? PL. When I am saying without recycling, so that cumulative gain or loss will not be recycled to PL. For example, we have the revaluation surplus, but the revaluation surplus is with recycling, without recycling. With recycling means the gain or loss will be ultimately transferred to PL. Without recycling means gain or loss will never be transferred to PL, it will be transferred retained earning. So the revaluation surplus was also OCI component. So revaluation surplus is with recycling, without recycling. Without recycling. So can you say whenever there is an OCI component, it can be with or without recycling. So what Ind AS 109 says that if it is debt instrument, it will be with recycling. If it is equity instrument, it will be without recycling. So can you say overall, if I say there are four categories. One is AC, one is FBTOCI with recycling, one is FBTOCI without recycling, and one is what? FBTPL. There are four categories. Have you understood this point? Have you understood this point? Yes, sir. Correct. Now, coming to what? Initial and subsequent recognition and measurement. Again, this is important from examination point of view. So, initial recognition is done at fair value. Initial recognition is done at fair value plus transaction cost. Plus transaction cost. Correct. So initial recognition is done at fair value plus transaction cost, fair value plus transaction cost, fair value plus transaction cost for AC. For FBTOCI with recycling, for FBTOCI without recycling. But for FBTPL, Ind AS says it will be initially recognized as fair value. Transaction cost will be charged to PL as an expense immediately. Chalega. Very simple. So initial recognition is done at fair value plus transaction cost, but for FBTPL it is at fair value and transaction cost will be charged to PL as a expense immediately. Then subsequent recognition, can you say for AC, it will be subsequently recognized at what? Amortized cost by applying EIR. Correct. For FBTOCI with recycling, subsequently fair value, then this also fair value, this also fair value. Because the name is only fair value. Correct. However, can I say fair value gain or loss in this case is not applicable. Amortized cost, there is no fair value gain or loss. But in the second case and third case, it will be transferred to OCI and will be accumulated in separate component of equity. Correct now. So it will be shown under other equity as some names should be given. However, that name is not given under Ind AS. So we need to give the name. Whenever name is not given to any reserve and surplus, we need to give the name now. So we can call it FBOCI reserve. FBOCI reserve. For example, for revaluation gain, they said revaluation surplus. For this, they are silent. So this will be transferred to OCI and accumulated in other equity. You can give one name as FBOCI reserve. चलेगा नाम अच्छा है. FBOCI reserve. Are you able to understand? You can give any other name also when you become CA. But right now what? FBOCI reserve. Can you say this gain will be transferred to what? PL. This gain will be transferred to PL. Correct. Then interest and dividend. Can you say in this case it will be calculated by applying EIR and transferred to PL. So whenever AC, interest income will be calculated by applying EIR. Always interest income, interest expense by applying EIR. कसम खाओ. Interest income, interest expense. Interest income for financial asset. Interest expense for financial liability. Always calculated by applying EIR. EIR is not market rate of interest. It may be market rate of interest, but EIR is not market rate of interest. Can I say whenever it is FBTOCI with recycling, it is a debt instrument. When I am saying FBTOCI with recycling, debt or equity? Debt instrument. Can you say it has some contractual cash flow? Means it is hold to collect contractual cash flow and sale whenever required. Okay, there is intention to earn interest income also. Therefore, in this case also, means whenever there is a contractual cash flow, always interest will be calculated by applying EIR. So in this also, interest will be calculated by applying EIR. But when I am saying FBTOCI without recycling, so can you say there is no contractual cash flow? So in this case, normally it will be equity instrument. So in this case, dividend will be recognized in PL, but when received. So in this case, dividend will be recognized when received in PL. So dividend will be recognized in PL when received. So there is no EIR. If there is no contractual cash flow, there is no question of EIR. You can calculate EIR only when there is a contractual cash flow. And can I say whenever it is held for the purpose of trading, then also there is no contractual cash flow. Means FBTPL, there is no contractual cash flow. In this case also no EIR, and in this case normally will not recognize any interest income or gain. I will give one star mark for this. Understood? So in this case actually there are two thought. Two thought is, just try to understand what India says. India says that interest income will be calculated by applying EIR. And can you say for FBTPL there is no EIR? The question of recognition of interest income will not arise. Correct? Understood? But can you say it might happen we purchase one investment in equity shares and it is held for the purpose of trading. So there is no intention to earn dividend income. Suppose we purchase one investment in equity shares. It can be held for the purpose of trading. Okay, whenever it is held for the purpose of trading, whether there is an intention to earn dividend income, there is no intention to earn dividend income. There is intention to earn gain or loss on sale. Means intention to earn profit on sale. Are you able to understand? Whenever it is held for the purpose of trading, the intention to earn intention to earn some short-term profit. But it is quite possible dividend is received. Dividend received na? Are bolna rahe. So there are two thoughts. Dividend received can be transferred to PL or can be what? Adjusted with investment account. There are two thoughts. So ICAI is not clear about this. So from my point of view, it should be not applicable. Correct. Now ICAI is not clear about it because no question has been given for this particular point. Correct. Now, so we will not discuss much on this. Correct. Now we do detailed discussion in regular class for this, but I know no question will be asked from this topic. Can we ignore? Yes, sir. Then can I say gain or loss on derecognition? Can I say whenever it is hold to collect till maturity, the question of gain or loss will not arise. If it is hold to collect contractual cash flow till maturity, the entire amount will be collected. So there is no gain or loss on derecognition. But in this case, gain or loss on derecognition will be transferred to PL whenever it is with recycling. Whenever it is without recycling, so can I say ultimately we are not recycling to PL, so it will be transferred to OCI only. But you can see in this case, we are ultimately recycling the gain or loss to what? PL only. Therefore, gain or loss will be transferred to PL. And in this case, gain or loss will be transferred to PL only. Understood? The last point is what? About cumulative gain or loss of cumulative gain or loss which are accumulated in separate component of equity. So this will be applicable in second case and third case only. Whatever has been accumulated in FBOCI reserve. So if it is with recycling, the cumulative gain or loss will be recycled from OCI to PL. So you can see cumulative gain or loss in equity will be recycled from OCI to PL on derecognition. But if it is what? FBTUCI without recycling, then cumulative gain or loss will not be recycled to PL. It will be transferred to what? Retained earning on derecognition, as we have done for revaluation surplus. Correct now. So it will be transferred retained earning on derecognition. Understood? Now from exam point of view, they ask question only based on AC. Till now they have not given good question for these three categories. They have given very simple question, fair value at the beginning, fair value at the end, the gain will be transferred where? Either to OCI or PL. That is the very simple question now. That can be done by you only. But good question they have asked only for what? Amortized cost. Understood? Yes, sir. Now, when I am saying amortized cost, one thing is clear that amortized cost will be what? By applying EIR. Correct. Now, just try to understand what this is. When I am saying financial instrument, financial instrument is a contract. This contract can be either at market terms. When I am saying market terms, it means contractual rate of interest is equal to market rate of interest. Understood? When I am saying market rate of, it is at market terms, means contractual rate of interest will be equal to market rate of interest. When I am saying off market terms, means contractual rate of interest is not equal to market rate of interest. Correct? Are you getting? Suppose a loan has been given. Market rate of interest is equal to 10%. It is given at 10% only. Correct. But in this case, suppose loan has been given. Suppose market rate of interest is 10%, but loan has been given at 4%. Are you able to understand? Quite possible. Normally to employee, to subsidiary, there may be some concessional loan, related party loan. So in this case, can I say, just try to understand. In this case, fair value will be equal to transaction price paid. Fair value is equal to transaction price paid. Means, suppose loan given is 10 lakh. So can you say the fair value will be equal to 10 lakh only? Because it is given at what market terms. But in this case, can you say fair value will not be equal to transaction price paid? If the loan is 10 lakh, the fair value is not equal to 10 lakh because it is not given at market terms. Means, can you say in this case we need to find out fair value? Because initial recognition is done at fair value plus transaction cost. Are you able to understand what I am saying? Correct? Now, what will be fair value? You only say. Fair value will be what? Hello. Fair value will be what? Hello. Present value of what? Is a contractual cash inflow discounted at what? 4% or 10%? Means at market rate of interest. Fair value is always calculated by taking market rate of interest. So at market rate of interest. Understood? Can you see whenever interest rate will increase, so present value will decrease? So can you say, of course, if the transaction price paid is 10 lakh, so this will be either 4 lakh or 6 lakh, whatever, but not equal to 10 lakh. So of course, suppose let us assume it is 4 lakh. It means what is the transaction price paid? 10 lakh. But fair value is what? 4 lakh. So this difference, we need to understand what is this difference. This depends upon the substance of the contract. Substance of the contract. Suppose if you are giving a concessional loan to employee, so can you say it means you want him to remain in the employee for the loan period? Okay, this is nothing but one type of EB expense, and this will be amortized in how many years? Till the loan period. So this will be known as prepaid EB expense, depending upon the terms of, depending on the substance of the contract. Means it will depend upon the facts and circumstances of that particular case. Understood? And can you see in these respective Ind AS will be applicable? If it is EB expense, apply Ind AS 19. Or it may be some other Ind AS. Are you able to understand? Have you understood this entire point? Once again, whenever contract is done at what? Market terms. If question is silent, what you will assume? It is at market terms, it is not at market terms. Market terms means whenever market rate of interest is not given, what will you assume? Suppose the question says loan has been given at 8% and question is silent. We will assume it is at market terms only. If question is silent, always assume it is at market terms. Then fair value is equal to transaction price paid. Thank you very much. But if question is given contractual rate of interest 4% and market rate of interest 10%, it means it is not at market terms. They need to find out fair value. Fair value will be equal to what? Present value of contractual cash inflow discounted at market rate of interest. And the difference between transaction price paid and fair value will be accounted separately, depending upon the substance of the contract as per respective Ind AS. But that we need to understand what can be it means as per the information given in the question. My question to you all, everyone, in this question, what will be EIR? Huh? No, you should say, Mr. whether there is any transaction cost. Just try to understand. Initial recognition is not done at fair value. Initial recognition is done at fair value plus transaction cost. Means if transaction cost is nil, then EIR is equal to what? Market rate of interest. But if they are given transaction cost, then we need to calculate what? EIR. Same concept. Now don't say 10%. Because I have not informed you right now about transaction cost, but initial recognition is not done at fair value. Initial recognition is done at fair value plus transaction cost. So it might happen some transaction cost is given. So initial recognition is done at fair value plus transaction cost. Then interest income will be calculated by applying EIR, which is not equal to what? Market rate of interest. Means you need to recompute what? EIR. Same concept whatever we have done. Have you understood? Means can I say question is very, means topic is very easy. Only you need to understand the substance of the contract. What is that difference amount? That difference amount is what? And that will be based on the question information. Can we take one question? First, let us read. You can see fair value. I have given detailed discussion on this. We have done discussion now. Transaction cost also you have understood. Initial measurement. If fair value are at market terms, fair value is equal to transaction price. This you delete once. Huh? This you delete if it is given. Acha. Transaction price is what? Transaction price paid is equal to what? Nominal value plus premium minus discount. Same thing. Understood? Here transaction price paid. There in case of financial liability, transaction price is received. In case of financial asset, transaction price is paid. It is same thing, nominal value plus premium minus discount. Correct? If financial assets are at off market terms, determine fair value. Fair value will be the present value of contractual cash inflow discounted by using market rate of interest. Treatment of difference between transaction price and fair value. Correct? Treatment. The difference, whatever difference is coming, with that we need to understand what. So there can be three situations in exam. Everyone. Means, can I say, at off market terms, difference is equal to what? Transaction price paid minus fair value. So what will be this difference? This accounting treatment depend upon three types of questions. Sometimes question will say if this difference is compensated by some amount which is received initially only. Correct now? Have you understood what I am saying? Have you understood what I am saying? One minute. Correct. Now just try to understand. Suppose market rate of interest is 10%. Correct. And I have given you loan at 4%. Correct. So difference is there. Means I have given you some concessional loan. So I will ask you, you compensate me right now only for that. Means the difference amount you compensate me right now only. Means can I say, then to it is equal to market terms only na. If you are compensating me. Understood now? So that compensation is known as origination fee received from the other party. So you have compensated me right now only. So if you compensated me by that amount right now, so again the transaction price paid will miss the fair value will be equal to transaction price paid minus origination fee received. Minus what? Origination fee received. And the fair value will be equal to transaction price paid minus what? Origination fee received. So sometimes the question will say the compensation has been done by other party by paying origination fee on the date of contract only. Means can I say in that case whatever origination fee is received will reduce from transaction price paid and that amount will be equal to fair value. Correct? But if suppose it is not compensated by origination fee, then whatever difference will be either expense or asset. Either it will be expense or asset. Can I say if there is no future recurring benefit, it is an expense. But if there is some future recurring benefit of that difference, that will be an asset. So that we need to understand the information given in the question. For example, if I say if you have given loan to employee and the employee need to retain in the employment for the term of loan, so there is a future recurring benefit. So it means it will be considered as prepaid expense, means asset. Are you getting what I am saying? But suppose there is no condition that employee can leave at any point of time. So no condition, so no future recurring benefit, no future recurring benefit. So this will be charged to PL as a expense. Are you able to understand? That is only given. Check करेंगे. Treatment of difference if compensated by receipt of origination fee. Fair value is equal to transaction price paid less origination fee. If not compensated by origination fee, extra payment provide future recurring benefit, recognize it as an asset. Apply respective Ind AS. Extra payment do not provide future recurring benefit, recognize as an expense immediately in PL. Understood? Have you understood? Correct. Yes, sir. Can I take one question? One question, very popular question that only I will take. Comfort Limited granted 10 lakh loan to its employee on 1st Jan 2009 at a concessional interest rate of 4%. Normally they ask this type of questions only of market terms. They will not ask question of market terms. So that will be easy na. Correct. Loan is to be repaid in 5 equal installment along with the interest. Market rate of interest for such loan is 10%. What is the contractual rate of interest? Contractual rate of interest. Market rate of interest. Market terms of market terms. Market terms of market terms. Of market terms. Fair value will be equal to transaction price paid or will not be equal to transaction price paid. Will not be equal to. Means we need to find out fair value by taking which rate of interest? Market rate of interest. Okay? Following the principle of Ind AS 109, record the journal entry and calculate the value of loan liability. Correct? Can you say whenever question is silent, this will be always hold to collect contractual cash inflow? Means it will be always amortized cost only. Means any type of receivable, so can you say hold to collect contractual cash flow till maturity? If question is silent, all types of receivable will be always at amortized cost and question will be silent. Means normally in exam what they ask? Only AC. They don't ask what? FBTPL and FBTU. Till now they are not asking. They are asking means they want to kill you. Understood? Have you understood? So can very simple now. Batao. Can you say in this case we need to find out fair value of loan? So what will be the fair value of loan? Batao. How to calculate fair value of loan? You need to find out contractual cash inflow. So what is the principal? It is paid in 5 equal installment. So 2 lakh, 2 lakh, 2 lakh. You can see principal inflow is what this. Correct. Then you need to find out contractual interest amount. So contractual interest amount 4% first on 10 lakh. It will be 40,000. Then 4% on 8 lakh 32,000. Are you getting? Then 4% on 6 lakh 24,000. Then 4% of 8 lakh 16,000. Then 4% of 2 lakh 8,000. This become total contractual cash inflow discounted at what? Market rate of interest means 10%. You will get present value. This become fair value of loan. What was the transaction price paid? 10 lakh. 10 lakh minus this will be what? Prepaid employee benefit expense. Whenever loan, it will be always prepaid employee benefit expense. And that prepaid employee benefit expense will be amortized during 5 years on SLM basis. Journal entry we can do. Amortized cost table we can prepare. Whenever this type of question, always prepare this amortized cost table also. How to prepare amortized cost table? Year end, opening receivable, interest by applying what? Interest by applying contractual rate of interest, market rate of interest, EIR. EIR. Whether any transaction cost given, it will be equal to what? Market rate of interest. Suppose if in this question I would have given there is a transaction cost of 10,000, then you need to calculate what? EIR also. Correct? Understood? Correct. Then can I say we can find out contractual cash inflow. This is opening balance plus interest minus contractual cash inflow will be amortized cost. This to you are expert, you can do it by your own. Then based on this we can pass journal entry. What is my first journal entry? Loan receivable account debit, prepaid employee benefit expense account debit to bank. Correct? Bolo. Second journal entry at year end. What journal entry will do? Interest income or expense. So amount is received bank account debit. How much received? 2 lakh 40,000. Amount received what? 2 lakh. To interest income how much? And the difference will be reduction of financial asset. So journal entry become bank account debit to interest income to financial asset. Second journal entry, third journal entry, fourth journal entry, fifth journal entry all remain same. Only amount will change. At the end, the entire amount will be collected. Means this entire amount will be collected. It will be automatically de-recognized. Understood? That journal entry is given. But normally in exam they ask first year journal entry. Normally. So this journal entry they have given. They have given two journal entry first. Staff loan to bank. Then staff cost to staff loan account. We can compound these two journal entry. or better write down prepaid EB expense. Correct now. Understood? Now in this question they have considered this difference as an expense. But as per latest question given by ICAI, they say no, this should not be expense, this should be prepaid employee benefit expense. Why? Because it will give future economic benefit for 5 years. So initial study material they have considered difference as an expense, but now they have rectified. That was not correct. So in this I have not rectified, but I hope you have understood. This will be prepaid EV expense. For loan, always will assume, yeah, of course they need to remain in employment for 5 years. It means there is some service condition. If there is some service condition that need to be fulfilled, so it will give benefit for 5 years. So it will be prepaid EV expense. That is only correct now. Understood. I hope you have understood this. Any doubt? Follow. One more question. A Limited issued redeemable preference shares to a holding company, Jain Limited. The terms of instrument have been summarized below. Account for this in the books of Jain Limited. Everyone. Now, there is one subsidiary company, there is one holding company. Subsidiary company has issued what? One non-cumulative redeemable preference shares. Correct. So, for holding company, it is a financial asset. For subsidiary company, it is a compound financial instrument. It is non-cumulative redeemable preference shares. Non-cumulative, it can be either at the discretion or it can be mandatory. Correct. Let me see what they have given. Redeemable after 5 years, date of allotment, date of repayment, total period, value of preference shares issued. Correct. Then dividend rate 0.001%. Acha, 0 point dividend rate. Correct now. Market rate of interest 12% per annum. One thing is clear, it is not at, it is off market terms now. Off market terms, present value factor they have given. Now, just try to understand. They have given non-cumulative redeemable preference shares. It is redeemable, this is principal amount. Now this dividend can be either at the discretion or it can be mandatory. If you assume mandatory, then it becomes total financial liability. And if you assume at the discretion of entity, so it become compound financial instrument. But this question we are doing from this point of view, not from subsidiary company point of view. Can you see, if they ask from subsidiary company point of view, you can do it by your own. Either it will be compound financial instrument, or it can be pure financial liability. But we are doing this question from holding company point of view. In the books of holding company, it will be financial asset, investment in preference shares. Correct now. So now this financial asset, so can I say, in this case, can I say there is some contractual cash flow and this will be hold till maturity. So this will be amortized cost only. It is at off market terms. So we need to find out fair value. Then this we need to find out difference between fair value and transaction price, and then we need to find out the difference amount. Correct? Have you understood what I am saying? Have you understood what I am saying? Correct? Yes, sir. What we'll do? First we'll calculate what? First we'll calculate what? First we'll calculate initial recognition will be done at what? Initial recognition will be done at fair value plus transaction cost. Whether in this question it is at market terms or at off market terms? Off market terms. It means we need to find out what? Fair value of loan. So transaction price is 10 lakh. 10 crore. 10 crore na? Transaction price paid is 10 crore. Then we have to find out fair value of loan. Fair value loan. Correct. Understood. So can you see there is no, because in this question, from this question we can understood there is no contractual obligation to pay dividend. So there is no contractual right to receive dividend. There is no contractual right to receive dividend. So dividend amount will be nil, 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 nil. So only there is a contractual right to receive principal amount. Only there is a contractual right to receive principal amount. Understood. So what is the principal amount? It is 10 crore. We can find out present value of that 10 crore. The present value of 10 crore will be what? They have given discounting factor also. So 10 crore multiplied by this is equal to 5 crore 67 lakh 43,000. The difference become transaction price paid, and the difference between transaction price paid and fair value of loan is equal to this amount. Correct. Now we need to understand what is that difference. Correct. Now just try to understand. I am holding company, you are subsidiary company. So I have given some amount to you. Out of that some amount is receivable. That is the fair value of loan, and some amount is not receivable permanently. Means that is given permanently now. So guys, whatever has been given permanently to subsidiary company, it is just like investment in equity instrument. Just like investment in equity instrument. Understood? Have you understood this point? So this difference will be considered as investment in equity instrument of subsidiary company. Understood? And investment in equity instrument of subsidiaries, associate and joint venture is scoped out from this chapter. Because for that Ind AS 27 is applicable, Ind AS 109 is not applicable. So any investment in equity instrument of subsidiaries, associate and joint venture, Ind AS 109 is not applicable. What is applicable? Ind AS 27 is applicable. Means investment in equity instrument of other entity, Ind AS 109 is applicable. But investment in equity instrument of subsidiaries, associate and joint venture, Ind AS 109 is not applicable. What is applicable? Ind AS 27 is applicable. Means this investment is also financial asset, but is scoped out from this chapter. Understood? Have you understood? So what journal entry will do? You say. What is journal entry? First, loan receivable account how much? Loan receivable 56 lakh 74,000. 5 is what? 5 crore 67 lakh 43,000. Investment account debit how much? 4 crore 32 lakh 57,000. To bank how much? 10 crore. Correct. Will you recognize any interest income? Will you recognize any interest income? Yeah. Can you say on this we need to recognize interest income by applying what? Yeah. Whether any transaction cost given. Whether any transaction cost given. If transaction cost not given, EIR will be equal to market rate of interest. So what is the market rate of interest? 12%. We have done discounting also at 12%. Correct. So we need to recognize interest income. So this journal entry will do. Okay, subsequent recognition we can do by applying amortized cost table. So opening receivable is this. Interest we can calculate what at 12% contract. So cash inflow is 0, 0, 0, 0. Then 10 crore. Then this will become amortized cost. This we can calculate by our own. Okay. Based on this, can I say we can pass journal entry? What is journal entry for the first? First journal entry, loan receivable account debit, investment account debit to bank. Then at year end, we recognize interest income, loan receivable to interest income, but there is no contractual cash inflow. There is no contractual cash inflow. Second year also there is same journal entry. Third year also same journal entry. Fourth year also same journal entry. Fifth year also same journal entry, and automatically the entire 10 crore will be received. Understood? This much, any doubt? बोलो. Have you understood this? Any doubt? So I have taken two questions of financial asset. Are you getting any issues, live students? Live students, are you getting any issues? I will give you my entire class notes for my regular batch. So you will get all the solution whatever I have done in my class, regular class, you will be able to understand. I'll just forward it today only. Chalega? Any point which you have not understood, can you ask me once second, because I am not able to understand whatever you have written previously. Have you understood whatever I have said? Sir, compulsory cumulative and compulsory convertible preference shares. This is investment in equity shares and held for contractual cash flow. What you are saying? I am not able to understand. Compulsory cumulative and compulsory convertible. This is doubt you are asking or what? Whether this doubt is related to this question. But it was not compulsory dividend, na? It was cumulative dividend. What are you asking? Your doubt I am not able to understand. Once again I will repeat what I have said. I said in this question, doubt is regarding the last question only, na? This question, A Limited has issued non-cumulative redeemable preference shares to Jain Limited. Because it is non-cumulative, so of course can I say the dividend is at the discretion of what? A Limited, correct? So there is no obligation to pay dividend. Redeemable preference shares, so there is an obligation to pay principal amount. So for A Limited it become compound finance instrument. Now for A Limited you can apply Ind AS 32, you can split it. But this question we are doing from Z Limited point of view. So for Z Limited it is a financial asset which is not at market terms. So we need to find out the fair value and then compare with transaction price. The difference what I said, because whatever difference is the extra amount paid which is not receivable from subsidiary company, and therefore it will be treated as investment in equity instrument. Suppose they give convertible cumulative preference shares, then also same. Non-cumulative, cumulative is same. Both non-cumulative, cumulative, it can be either at a discretion or not at the discretion. You need to just assume if question is silent. Correct now. In this question, they have not said about mandatory dividend. We have assumed that it is at the discretion of entity. Correct? Understood? Cumulative, non-cumulative, both are same only. Cumulative means what? Which if not declared, it will be carried forward. Non-cumulative means what? If not declared, it will be cancelled forever. But can you say whether cumulative dividend or non-cumulative dividend will be given? That can be at the discretion or not at the discretion of entity. So that you need to understand. Are you getting what I am saying? So it will not change your answer even though it is cumulative convertible. Even though it is convertible cumulative dividend also, the answer remains same, because cumulative dividend may be also at the discretion of what? Entity only, na? Got it? Have you understood? Understood. Chalo. Yes, sir. Now coming to the next point. One summary I have given, this will help you to revise. So let us see the summary. Normally this summary is from examination point of view. This summary is from examination point of view. So investment in equity shares, can I say investment in equity shares can be investment in subsidiaries, joint venture, associate, then scoped out from this chapter, refer Ind AS 27. But if it is investment in other entity, it can be held for the purpose of trading, then FBTPL. And if the question is specifically mentioned, then we can apply FBTOCI without recycling. Means if question is specifically mentioned, then only apply. Otherwise apply what? FBTPL for investment in equity shares. It cannot be AC. It cannot be AC. I hope you have understood this. Then investment in debentures and other securities. The investment debenture, if it is held for the purpose of trading, then what? FBTPL. If it not held for the purpose of trading, then find out held to collect contractual cash flow till maturity. If yes, then amortize cost by applying EIR. And if it is held to collect contractual cash flow and sale whenever required, then FBTOCI with recycling. In both cases, can I say interest income will be calculated by applying EIR? In both cases. Chalega? Yes, sir. Then concessional loan given or security deposit. Concessional loan given. Concessional loan given to any party. Correct? Or security deposit. Just try to deposit normally is at interest free. Deposit is always interest free, but that is contract. But can you say whenever you have given any deposit, so it is always at off market terms. So it will be recognized as fair value only. And the difference we need to understand what is that. Are you getting? I'll just say. So can you say whenever concessional loan given or it is a security deposit, yes, security deposit is always at off market terms. Are you bolna rahi? Because it is given without any interest. It is always at off market terms. So as per our concept, we'll say transaction price paid minus what? Fair value loan. Fair value of loan will be present value of contractual cash inflow discounted at market rate of interest. The difference will be what? Either expense or prepaid expense. For example, just try to understand. For example, you have given deposit for a lease transaction. This question have been given in ICAI study material. You have given deposit. You are lessor or lessee? Lessor will receive or lessee will receive? Deposit will be received by which party? Who will pay deposit? Lessee? So if I have given deposit, so I am lessee. Correct? Now deposit given. Can you see this will be refundable at the end of the lease term? But without any interest. It will be off market terms. Now suppose deposit is 1 crore. Then a present value may be only 40 lakh. The difference coming 60 lakh. So this 60 lakh is nothing but, can I say, lease payment. You are paid for taking the asset on lease. Yes or no? This is nothing but will be considered as a lease payment. And can I say any initial lease payment will be added to ROU asset? If you remember Ind AS 116, Means this will be accounted, just write down, this will be accounted as Ind AS 116 if it is a for a lease transaction. One question has been given in ICAI study matter. Can you refer that question by your own? Or I will take right now. Have you understood? One question has been given, that question I have not taken. Are you able to understand what I am saying? Correct? But skin is simple only. I should take question. I will take at the end. But I have not taken that question in my question booklet. I need to find out. But have you understood this point? 60 lakh. For that you need to understand Ind AS 116. But can I say it will be lease payment paid initially only? Now what Ind AS 116 says that, have you understood this is lease payment or not? Whatever you are paying extra, that extra you are paying for lease transaction, and whatever you are paying for lease transaction will be lease payment, and any amount of initial lease payment paid will be added to ROU asset. Are you getting? Means we will pass one journal entry. Journal entry what? If you say journal entry what? Loan receivable account debit, ROU asset account debit to bank. And on this Ind AS 116 will be applied for depreciation, etc. Understood? One question has been given. If you want to do it by your own. Today you will do. If you are not able to understand, I will do it. Chalega? But that is a good question. Chalega? Yes, sir. Then, next point, concessional loan to subsidiary company. One question I have given right now. Concessional loan to subsidiary company. So in that case, 1 second, transaction price less fair value loan, the difference will be considered as what? Investment in equity instrument. So what journal entry you will do in the books of parent company? Loan receivable account debit, investment account debit to bank. What journal entry you will do in the books of subsidiary company? Okay, it will be bank account debit to loan payable to equity instrument. This is nothing but compound instrument. Can you see it can be reverse also? Concessional loan to parent company. So concessional loan to parent company, same thing, transaction price paid less fair value of loan. The difference will be what? The difference will be what? Deemed dividend. Because in this case, subsidiary company is paying to what? Parent company. So subsidiary company will distribute dividend. It will become deemed dividend income for parent company. So what journal entry will do in the books of parent company? Bank account debit to loan payable to dividend income. What journal entry in the books of subsidiary company? Loan receivable account debit to deemed loan receivable account debit, deemed distribution account debit to bank, and this deemed distribution will debited to retained earning. This is also important from examination point of view. Have you understood? Then demand deposit. Demand deposit means, can I say, any deposit which can be demanded, we need to pay it. Demand deposit means any deposit received or paid. So what they say, demand deposit is nothing but current item. So this will be recognized at undiscounted amount. Because it is payable or receivable on demand now. It is payable or receivable on demand, so it is current item. So there is no need to do any discounting. Are you able to understand? For example, can I say current account, bank balance, current account. Current account is nothing but demand deposit. So will you do discounting for that? No, not possible. Correct? So what they are saying, fair value of demand deposit will be the amount payable on demand in the books of party making the deposit, or as well as in the books of entity accepting the deposit. Means it is nothing but will be recognized at undiscounted amount. Undiscounted amount. And there is no need to apply amortized cost method, means will not apply any amortized cost method on that. Got it? Understood? This is also important. One question has been given on this. There was one deposit given which is repayable on demand. So what will be journal entry when you have paid it? Deposit account debit to bank, repayment bank account debit deposit without any discounting. If there is no discounting, the question of interest income will not arise now. So will not recognize any interest income or expense as the case may be. Got it? Then Trade receivable. Can you trade receivable means Ind AS 115? Trade receivable means Ind AS 115. Means trade receivable is initially recognized as per the requirement of Ind AS 115. Because when I am saying receivable, trade receipt means revenue, revenue means revenue recognition as per Ind AS 115. So initial recognition is done as per Ind AS 115, but subsequent recognition may be done as per Ind AS 109 if it involves some significant financing component. So this you will automatically understand when we will do Ind AS 115. So I'll just when I will take Ind AS 115, I'll just give a reference of this point. There are some points which are linked with other Ind AS. So we can understood when we have done that Ind AS. Correct? Yes, sir. This point is not important. No question is given in ICAI study matter. Leave it. Any doubt? Any doubt? Understood? Then come to above page number 223. There is some modification in cash flow. Suppose initially there was some contractual cash inflow which was modified subsequently. Quite possible. Quite possible. Understood? Means initially there was some contractual cash inflow which was modified subsequently. Whenever it is modified, what Ind AS 109 says that carrying amount will be restated. Carrying amount will be restated. Correct. At present value of remaining contractual cash flow as per modified terms. Discounted at original EIR. Understood? Means, let me take one question. Let me take one example. Suppose initially there was 5-year contractual cash inflow was 10,000, 10,000, 10,000, 10,000, 1 lakh 10,000. So initially we have done present value of this. This become fair value. Then we calculated amortized cost. Then we calculated amortized cost. But what happened? At this point of time there was some modification. Now they said we'll pay 20 and 100 yahan par. Modified. Modified. Change in terms and conditions. So what Ind AS 109 says that now you'll find out the present value of these as on this date by applying original EIR. Means this fair value was calculated at 10%. So this will be also what 10%. Then calculate restated amount. The difference of these will be either adjusted in expense or prepaid expense as the case may be. Understood? Means can I say when you have initially recognized there was some either the difference was transferred to expense or it was an asset prepaid expense. The difference will be adjusted either to expense or prepaid expense as the case may be. Have you understood this point? One question have been given in ICAI study material. That question is already asked in exam. But have you understood the concept? Concept you understood? One second. This concept, what they are saying. Initially my cash flow was 10, 10, 10, 10, 110. This was contractual cash inflow. And suppose it is at off market terms. You will calculate fair value of loan by using market rate of interest. So fair value you have calculated at this point of time. Then you have applied amortized cost and this is the carrying amount as on this date. But on this date modification happened. Now they said you need to pay 20 as on this date and 100 as on this date as per mutual understanding. Quite possible. There is a modification in cash flow. Whenever there is a modification in cash inflow, what Ind AS says, then you need to find out. You need to restate the carrying amount. At present value of remaining modified cash flow, discounted at original EIR. So initially what was my EIR? The discounting will be done at 10%. Now this amount may be different than this amount. So suppose this amount is what? 5 lakh. This become 4 lakh suppose. You reduce what? Your financial asset. This will be adjusted in expense or prepaid expense as the case may be. Means if initially the difference was transferred to expense, so this also difference will be transferred to expense. If initially the difference was adjusted in asset, so this will be also adjusted in the same asset. Now understood? That is only given. If there is a change in the timing or amount of estimated future cash flow, the carrying amount of financial asset will be recomputed at present value of remaining contractual cash inflow discounted by using original EIR. Any difference due to such prepayment will be prepayment or whatever you can add a modification. Due to such modification will be adjusted in PL or prepayment account as the case may be. Understood? One question has been given ICAI study material. I am assuming that you can do it by your own, but that question is already asked in exam. Correct? But can I say now if you know the concept you can attempt it? If you know the concept now, that question you can attempt it, because entire thing now depends upon what? Concept. Discounting to you are expert, calculation you have calculator. Only what is required? Concept is required. Correct? But if you don't know concept, then you can't use calculator. Are you getting what I am saying? Yes, sir. This also done. With this, we have done discussion of what? Financial asset. Financial asset discussion done. Understood? Once again, I will repeat, the doubt came about off-market terms. Whenever there is an off-market terms, it means we need to find out fair value. Fair value means what? Present value of contractual cash inflow discounted at market rate of interest. Understood? So whenever you are calculating fair value you are calculating by discounting at market rate of interest. Now the question is that you recognize interest income by taking which rate of interest? So always EIR. But I said if there is transaction cost, so initial recognition is done at fair value plus transaction cost. So if there is a transaction cost, EIR will not be equal to market rate of interest, means EIR you need to recalculate. But if there is no transaction cost, the initial recognition done fair value only, then can I say EIR will be equal to what? Market rate of interest. This discussion we have done. Same discussion we have done in financial liability also. Correct? I think no changes there now. What is the doubt? Have you understood now? Correct. Now next topic is reclassification of financial asset. Now reclassification of financial asset, no question has been given in ICAI study mate. Whatever question they have given, that is only to understand the topic. But no full-fledged question has been given. Do you want me to take this concept? Let me take reclassification of financial asset. Now whenever we say reclassification of financial asset, so financial asset which are debt instrument, that only can be reclassified. Means that instrument can be AC, it can be FBTOCI, or it can be what? FBTPL. Now AC may become FBTOCI or FBTPL or vice versa. This is known as reclassification. Can I say business model changes, so reclassification is required, but reclassification of equity instrument is not permissible. Derivative instrument will be always FBTPL. So only reclassification of debt instrument is permissible. Correct. Now there can be three types of reclassification. Reclassification of AC to FBTPL, FBTOCI. Now whenever we do reclassification, there are 3 points. What will be the reclassification done at what value? Second, reclassification gain or loss will be transferred to what? Third, what will be the impact on EIR? Correct. When I am saying reclassification of AC to FBTPL or FBTOCI, reclassification done at fair value on reclassification date. At fair value on reclassification date. Chalega. Any gain or loss will be transferred to PL and OCI. Why PL? Because this is FBTPL. Why OCI? Because this is OCI. Can you say when it is FBTPL, the question of EIR will not arise, so not applicable. But when it is FBTOCI, so we need to calculate EIR. But in this case, whatever EIR we have taken for AC, that EIR will prevail. Means no adjustment is required for EIR if AC become FBTOCI. So no adjustment due to reclassification, it means use original EIR. Understood this point? Have you understood? Correct. When reclassification is done from FBTPL to AC and FBTOCI. When I am saying FBTPL to AC and FBTOCI, once again reclassification is done at fair value. Reclassification gain or loss will be transferred to PL and PL. PL and PL. Understood? And can you see whenever AC and FBTOCI we require EIR, but for FBTPL there was no EIR. So in this case we need to calculate EIR. So EIR will be calculated by taking fair value on reclassification date. Means can you see EIR will be equal to discount rate at which present value of remaining contractual cash inflow will be equal to what? Fair value on which date? Reclassification date. You can apply IRR concept. You can apply IRR concept. Understood? Have you understood this point? Now one doubt will come. Doubt is what? Sir, in previous case you have said PL OCI. But here you are saying PL. One doubt will come now. Have you understood? Just try to understand. Whenever we do reclassification is done on retrospective basis or prospective basis? Prospective basis means, just try to understand. Suppose it was initially FBTPL and this is the reclassification date. Initially it was 10,000 and now it become 12,000. My question to you all, this 2000 gain is of which period? When it was FBTPL, when it become FBTOCI? Okay, this gain should be transferred to PL only. Bole yes or no? Correct. Now, when I am saying FBTPL to what? AC. So once again, 10,000, 12,000. So this gain belong to which period? When it was what? FBTP only, it will be transferred to P only. Means doubt is not in this. This is correct. This is correct now. The doubt will come where? Now doubt will come here. Ki why this? Let me come once again. Suppose it was AC. Everyone. AC. Now it become what? FBTPL. Initially it was 10,000. Now it become 12,000. Gain is equal to 2,000 only this period. But for AC, any gain or loss was transferred to PLOC? No. Means now whatever gain is accumulating, this is on this date now. Because this gain to we have never transferred to PLOC because it was AC. AC mein there was no fair value gain or loss. Means can I say this gain related to on the date of reclassification, now it become FBTPL. This will be transferred to what? PL. And if it become FBTOCI, it will transfer to what? OCI. Have you understood? I hope you understood now why it is PLOCI, why it is PL. Got it? Got it? Now, Coming to reclassification of FBTOs here, same thing. Measurement at fair value on reclassification date. Measurement at what? Fair value on reclassification date. Gain or loss now OCI. Understood why OCI? Because it was OCI. Correct. Can you say FBTOs here? So of course, if FBTOs here become AC, so same EIR will be used. So no adjustment due to reclassification. It means original EIR. But when FBTOs have become FBTPL, no EIR is required. But just try to understand, when FBTOs have become AC or PL, so there is some cumulative gain or loss in OCI. That cumulative gain or loss will be transferred to PL if it become FBTPL. Bole yes or no? So once it become FBTPL, can I say entirely recycled from equity to PL as reclassification adjustment? Means whatever cumulative gain or loss will be recycled to PL if it become FBTPL. But if it become AC, so can you see it should not be recycled to PL? Because for AC, there is no OCI gain or loss. There is no fair value gain or loss. So it will be adjusted with fair value of that asset on reclassification date. Means removed from equity but adjusted against fair value on reclassification date. Means it will be adjusted with the asset only. Because for AC, so there is no fair value gain or loss now. So whatever fair value gain or loss which has been accumulated to separate company equity will be adjusted with financial asset only. Understood? But there is no question based on this. I don't know whether they will ask this type of questions or not. Correct? Understood? So I have just done this. If suppose asked, you should be able to do it. Understood? Chalega. With this we completed what? Topic number 3. Topic number 3 completed. How many topics are there in this? 8 topics are there. So only 3 topics we have done from the morning. Can we come to topic number 4? Topic number 4 is very easy. Because already we have understood financial liability in compound financial instrument. So question already we have taken. So topic number 4 will be very easy, about recognition and measurement of financial liability. Now what India says that for recognition and measurement of financial liability are of 2 classification. One is what? FBTPL, one is what? Amortized cost. One is FBTPL, one is what? Amortized cost. Yes, normally financial liability represent contractual cash outflow. Yes, normally financial liability will represent contractual cash outflow. So whenever there is a contractual cash outflow, it will be always at amortized cost. But if financial liability are held for the purpose of trading, it will be what? FBTPL. Means I have given an example, debenture held for the purpose of buyback. So it means it is held for the purpose of trading, then will not apply amortized cost, then will apply FBTPL. Any gain or loss will be transferred to what? PL. Correct. Understood? And one more point, once again, Ind AS has given an option to the entity that you can designate any financial liability as FBTPL as per your choice. An option has been given. But if that option is selected, this is irrevocable options. Means can I say, if I say, so there are 2 type of classification. One is amortized cost and one is what? Held for the purpose of trading or designated as FBTPL, but both are same na. Held for the purpose of trading or designated as FBTPL as per the option given, both are same FBTPL only. Means there are 2 category, AC and FBTPL. But initial recognition will be done at what? For AC, it will be fair value minus transaction cost. Fair value minus transaction cost. For FBTPL, it will be at fair value. Transaction cost will be charged to PL as an expense immediately. On balance sheet date, we will apply amortized cost by applying EIR. And for FBTPL, it will be at fair value. Fair value gain or loss will be transferred to PL. Correct? That is only given, you can see. Interest will be recognized by applying EIR for amortized cost. In this chapter, for this topic also they will ask only amortized cost. They will give you all the information. Can I say you can do by your own? You can do it by your own, na? Financial liability. But normally for financial liability, they ask compound financial instrument. Because if they are asking compound financial instrument, so they are asking both equity and financial liability. And financial liability will be major amortized cost. Already I have taken one question there. In this question also, can I say market rate of interest and ER will be maybe different if there is a transaction cost. Same concept is applicable. So can I assume that this topic is automatically covered? But there is one good news that reclassification of financial liability is not permissible. Means reclassification of financial asset, debt instrument is permissible, but reclassification of financial liability is not permissible. Means reclassification point, so completed only. Topic number 4 completed. Understood. Now can we come to topic number 5? Understood. Correct. This much. Topic number 5. What is topic number 5? De-recognition. De-recognition of financial asset and financial liability. From my point of view, in this de-recognition of financial liability is more important than de-recognition of financial asset. Means for recognition of financial asset is more important, but de-recognition of financial liability is more important from examination point of view. Correct? So we'll give more focus to what? De-recognition of financial liability. Got it? Yes, sir. First, let us take de-recognition of financial asset, because of course we need to cover it. Now when I am saying de-recognition of financial asset, so can you say any financial asset de-recognized when? When any of the 4 conditions are satisfied. So what India says that financial asset de-recognized when contractual right to receive cash has been expired. Means if it is hold to collect contractual cash inflow and that is expired, means we receive entire amount, it is automatically de-recognized. Correct. Second, entity has transferred contractual right to receive cash flow from financial asset. Entity has transferred their right to other party. Means if I have a debtor and I said now you pay to this party, so I have transferred that right to you, so automatically debtor should be de-recognized from my balance sheet. But with this, what they said, also transfer substantially all the risk and reward of ownership of such financial asset. Just try to understand. Suppose I said to my debtor, please pay to this party, but in case of bad debt, I will bear. It means risk and reward is not transferred. If risk and reward is not transferred, will you de-recognize? No. Means it will de-recognize only when risk and reward is also transferred that party. Means in case of bad debt, he will bear or she will bear the loss of bad debt. Understood? Correct. Third case, entity retain the contractual right to receive cash flow but assume contractual obligation to pay cash flow from such asset. Means what happens? Suppose there may be one contract, I have a debtor and I need to pay to this party. So what I will say? I will collect the amount from my debtor, but once the amount collected, there is an obligation to pay to this party. Means we have done one arrangement. Correct now. This party said that you don't transfer, you retain the collection right with you. But once you retain, you need to pay the entire amount to this party. Means I have retained the contractual right to receive cash flow. But once the amount collected, there is a contractual obligation to pay to this party, and the risk and reward is also transferred to this party. Means if the amount is not collected, whose loss? This party loss. It means the asset need to be de-recognized. Understood? Are you able to understand? Correct. The last point, entity has not retained control of that financial asset. Means there is no control retained. Means suppose it might be investment in equity shares also. So can I say investment in equity share, there is no contractual cash flow. But can I say if I transfer the control of that investment to other party, automatically it will be de-recognized. So if I don't retain the control of such financial asset, control means what? Now can I say means I have no, if I have transferred the control, means now all the risk and reward is transferred now automatically. Correct? So the entity has not retained the control of the transferred asset, it will be automatically de-recognized. Understood this all points? Correct. Now coming to the accounting treatment. Accounting treatment depends upon whether it is a complete derecognition or partial derecognition. Complete derecognition means what? Entire component is transferred. Partial derecognition means what? Some component is transferred, some component is retained. Correct? It can be complete derecognition, it can be partial derecognition. Correct? So in case of complete derecognition, very easy. Can I say entire asset will be derecognized, generate will be bank account debit to financial asset, any difference will be gain or loss, which will be transferred to PL or OCI as the case may be. It can be PL or OCI as the case may be. AC, it means if it is FBT OCI, if it is FBT PL, depends upon that. Are you getting what I am saying? Yes, sir. This point you understood? Can you say if you have transferred financial asset and that financial asset is FBT OCI, so the cumulative gain or loss need to be also transferred. So what they said, any cumulative gain or loss that has been recognized directly in an equity will be reclassified to PL if it is debt instrument, will be transferred retained earning if it is equity instrument. Already we have done initially only. Have you understood this point? Means any cumulative gain or loss need to be recycled if that financial asset is FBTOCI debt instrument. It will be transferred retained earning if that financial asset is what? FBTOCI equity instrument. Got it? Understood? Correct? Yes, sir. Now for partial derecognition, this is one important topic, partial derecognition. Partial derecognition. Partial derecognition means some component has been transferred, some component is retained. Means either principal component transferred, interest component retained, or interest component transferred, principal component retained, or some portion of principal transferred, some portion of interest retained, some portion of both is what? Transfer retained. Quite possible. In that case, what will do? In that case, what will do? Correct now. I can take one example regarding this. Let us take one example. Correct. Suppose we have one financial asset, a loan, whose carrying amount is 10 lakh. Correct? Understood? Contractual rate of interest is 10%. And let us assume market rate of interest is also 10%. Means not market. ER is also equal to 10%. When I am saying contractual rate of interest and ER is equal to 10%, means this is at market terms and there is no transaction cost. Chalega? I can give you also what? Different EIR. But it will not make any difference. Understood? And this is what? Remaining 4 years. How many years? 4 years. Now, this loan was transferred to P Limited. But transferred what? 40% principal amount transferred and 70% interest amount transferred. Understood? Expected yield rate means current market rate of interest is equal to 12%. Quite possible. My question to you all, if you are transferring the asset right now, you will transfer, means if you are transferring the asset right now, so it will be transferred at current fair value. Current fair value will be calculated at current market rate of interest. Understood what I am saying? Means this loan was taken, this loan was given, suppose 5 years before, and this is the remaining life. So now, can you say first you need to calculate fair value of loan on the date of derecognition? How to calculate? You will give me. What is step number 1 in this? First calculate fair value of loan. So fair value loan means what? There are two components, principal component and interest component. The principal component is how much? Nothing is given, it is redeemable at par only. It is amount is 10 lakh, so that will be only received. So 10 lakh. Can you say it will be multiplied by what? Present value factor at a rate of 12% for 4 years. Can you give me what is the amount? How much? How much? 0 point? Six 355. It is coming how much? 6 lakh 500. ठीक है ना? Then interest component is 1 lakh into present value annuity factor at a rate of 12%, 4 year, how much? How much? 3.037. It is annuity factor. 3.037. This is coming how much? So can I say you have calculated fair value loan. The total fair value loan become these two amount. Correct. Now step number 2, what you will do? What they said? Allocation of carrying amount. So what they said? First find out portion transferred. So can I say how much principal portion transferred? As per my question, 40%. And how much interest portion transferred? 70%. Then find out portion retained. How much principal portion, how much interest portion? Are you able to understand? Now we know fair value. So fair value of principal portion 40%, can you give me? It is 6 lakh into what percent? 40% how much? 2 lakh. And how much 60%? 3 lakh 81 300. Similarly, what is the fair value of interest component? 3 lakh 3,735 into 70% how much? And how much 30%? 91 120. Can you give me the total of all this? You can give me this total also. Then all 466 466 And the total, give me total of these three, means these three total. 9,39,235. Now what is the carrying amount? Carrying amount is 10 lakh. So what India says that this 10 lakh will be allocated in this ratio, So the 10 lakh carrying amount will be allocated in the ratio of fair value of portion transferred and portion retained. So can you allocate in this ratio? This, can you give me this amount, and this amount? Four lakh 97. Then 97 015. Understood? What will be journal entry? For the portion transferred, journal entry, what is the fair value of consideration received? So how much you have received? This much amount you have received. Fair value you have received. Correct now. So bank account debit how much? 4,66,000. And how much D recognize? How much loan D recognize? 4,97,016. How much difference? Difference will be loss. Loss how much? 31,000. Are you able to understand what I am doing? And for the portion retained, what journal entry? What they said? To recognize principal portion, principal, we call it principal strip account debit, and interest strip account debit to loan account. And this will recognize that they are carrying amount only. Means on this there is no gain or loss. This amount and this amount. So how much is 4 lakh? 5,000. 968 and 97015, total of this 9 lakh 983. Understood? Normally in exam, student do mistake in this amount. They will take fair value, but the portion retained will be recognized that they are carrying amount only, because there is no gain or loss on portion retained. Have you understood this journal entry? Have you understood? Follow. Correct? Yes sir. That is only given. Check करेंगे. For partial derecognition, when a portion of contractual right to receive cash flow is transferred, step number 1, calculate fair value. Calculate what? Fair value of transferred and retained portion by applying expected yield rate of transferee. If fair value is not given the question, sometimes fair value might be given the question only. Thank you very much. If not given, we will calculate present value by applying what? Expected yield rate of transferee. Means what is the expectation of transferee? That is nothing but current fair value, current market rate of interest, current market rate of interest adjusted with some risk factor. Risk factor means there may be some chances of bad debt, etc. So there may be some credit risk. So that market rate of interest may be adjusted with what? Some risk factor. That become expected yield rate of transferee. So that expected yield rate will be given the question only. Are you getting? Then you will allocate the carrying amount. You will allocate the carrying amount of financial asset in the ratio of that fair value. That only give. Then accounting treatment for transferred portion, bank account debit to financial asset. Any gain or loss will be transferred to either PL or OCI as the case may be. Then for retained portion, you can see what journal entry I have given: principal strip account debit, interest strip account debit, servicing asset account debit to financial asset. Servicing asset means what? Is sometime the transferor become collector. I say now we can collect on behalf of other party. So whenever we collect on behalf of other party, so we'll charge some fees for that. That is known as collection fee. So that collection fee for that collecting the amount, we receive some amount from that party, or we may retain some portion of interest. So whatever amount we have retained for collecting the amount, that is known as servicing asset. So that will be also recognized separately. Are you getting? Servicing asset account debit to financial asset. But this will be at what? Allocated carrying amount. Got it? Correct. Now, whenever partial derecognition, so once again there can be some cumulative gain or loss. So what they are saying, that cumulative gain or loss will be also allocated to transferred portion and retained portion in the ratio of their carrying amount. Sorry, in the ratio of their fair value. That cumulative gain or loss means if it is FBT or CI, so there will be some cumulative gain or loss. So that cumulative gain or loss will be also allocated to transfer retained portion in the ratio of their fair value, and cumulative gain or loss allocated to transferred portion will be either recycled to PL or transfer retained earning, as the case may be. Got it? But this type of question they have not given in ICAI study material. Have you understood this point? Follow. Any doubt? Are you getting what I'm saying? Have you understood? Correct. We'll take 5 minute break and then we'll continue the derecognition of financial liability. अरे यार ये बात। हेलो हेलो चलो, can we start once again? So one doubt came once again in the break, that once again repeat the accounting treatment of what? De-recognition of financial asset. De-recognition of financial asset, I hope it is very simple once you have understood step. Complete de-recognition to very easy. Complete de-recognition, what we have done? Complete de-recognition means what? Bank account debit to financial asset, any gain or loss will be transferred to PL or OCI. However, if there is any cumulative gain or loss in case of FBT OCI, so that cumulative gain or loss will be either recycled to PL or transfer retained earning, as the case may be. I hope you have understood this point. In case of partial de-recognition, so can you say first we need to find out what is the fair value of portion retained, what is the fair value of portion transferred. This fair value may be given in the question, or we need to calculate it. This fair value of retained portion or fair value of transferred portion may be either given the question, or we need to calculate it. So if not given, we need to calculate it by applying the expected yield rate of transfer. Expected yield rate of transfer is nothing but current market rate of interest adjusted with the risk factor. Correct. However, that expected yield rate will be given. We can calculate easily. Then the carrying amount will be allocated in the ratio of fair value. Means first find out fair value of transferred, fair value retained portion, carrying amount will be allocated in that ratio. Then for transferred portion, what journal entry? Bank account debit to financial asset, any gain or loss will be transferred to OCI or PL. And for retained portion, we need to pass one journal entry. So we'll say principal strip account debit if retained, interest strip account debit if retained, servicing asset account debit to financial asset. But this journal entry will be done with allocated carrying amount. What is the meaning of servicing asset? Sometime the transferor become collector. If transferor become collector, they will charge some fees from transferring because we are collecting on their behalf. So some portion of interest or principal may be retained for that fees purpose. So that amount whatever retained is known as what? Servicing asset. Correct. So that information will be given the question. There are some questions given. You can look into that. You will be able to understand if you have understood. Have you understood now? Follow. Can we what? Can we proceed? Yes. Then there is one point, transfer that do not qualify for de-recognition. Means, can you say if the risk and reward is not transferred, then the transfer will not be de-recognized, means financial asset will not be de-recognized. So in that case, whatever consideration received will be considered as financial liability. Means you have transferred the asset, but risk and reward is not transferred. Can you de-recognize? No. But you have received the consideration. Whatever consideration received will be considered as financial liability, and that financial liability will be measured at amortized cost. Means, can I say in your balance sheet financial asset will be also there and financial liability. Apply financial asset at measurement principle as what you have done either at FBTPL, OCI or AC. And can I say financial liability will be now carried at amortized cost. So on that interest expense will be calculated by applying EIR. Understood? Correct. Then there is one concept about continuing involvement of the entity in the transferred asset. Continuing involvement of entity in the transferred asset. Understood? Just try to understand what this is. Suppose you have transfer the asset. Correct? Understood? But for some portion you have given guarantee. Guarantee has been given. In case of bad debt, this much amount is guaranteed. But over and above, the entire risk and reward is not retained. Means risk and reward is also transferred. In that case, this concept is known as continuing involvement in the transferred asset. Correct now? Means just try to understand what they want to say. Suppose you have transferred an asset of rupees 10 lakh, but you have given a guarantee that if bad debt amount is 5 lakh, we guarantee this much to you. Means in case of bad debt to the extent of 5 lakh, this is the amount we have given guarantee. But if the bad debt is more than this, then it is your loss. Means can I say to the extent of 5 lakh, there is a continuing involvement. To the extent of 5 lakh, there is a continuing involvement. Okay, to the extent of 5 lakh, this much assets should not be de-recognized. Or we can say to the extent of 5 lakh, financial assets should be recognized. Means you can de-recognize the entire asset, but you need to recognize this portion because you have a continuing involvement in that. Because to the extent of 5 lakh bad debt, you are going to want that loss because you have given a guarantee for that much loss. So this concept is known as continuing involvement in that asset. Understood? Correct. One question has been given in ICAI study matter regarding this. If you want, I can take that question. Do you want me to take that question? Let me take that question, but I need to go to what? My book for that. Let us go. Come to financial instrument chapter. This question. Question 34. Entity C agree with a factoring company. Factoring company, you know, factoring means to whom the debtor is transferred or trade receivable transferred, that is known as factoring. That arrangement is known as factoring. Correct. So entity C agree with the factoring company D to enter into that factoring arrangement. Under terms of arrangement, the factoring company B agreed to pay 91.5 crore less a servicing charge of rupees 1.5 crore. Net profit is equal to 90 crore. In exchange for 100% of cash flow from short-term receivable. The receivable has a face value of 100 crore and the carrying amount of 95 crore. The customer will be instructed to pay the amount owed into a bank account of the factoring company. Entity C will also write a guarantee to the factoring company under which it will reimburse any credit loss up to 5 crore. Understood? Entity C also write a guarantee to the factory company under which it will reimburse any credit loss up to 5 crore. Over and above the expected credit loss of 5 crore and loss of which 15 crore are considered reasonably possible. Means what they are saying ki even though the loss of 15 crore is reasonably possible, but the guarantee has been given only for 5 crore. Means in this case you can understand even though asset is transferred, there is some continuing involvement in that asset. The guarantee is estimated to have a fair value of 0.5 crore. What is the value of guarantee given? That is 0.5 crore. Understood? Means you can see what happened. There are two companies, one is C and D. C has transferred a financial asset at rupees how much? at rupees 91.5 less 1.5 means 90 crore. Means 90 crore is the consideration received, and they have transferred an asset whose carrying amount is how much? 95 crore. So they have transferred an asset whose carrying amount is 95 crore. Correct. This much you understood? Correct. But in this case, the C has given also guarantee. Now whenever we give guarantee, nothing is free. So if I am giving a guarantee, so again for guarantee I will receive some consideration, nothing is free. If I am just giving guarantee that you will pass, so my fees will be ज़्यादा ना. My fees will be more if I am giving a guarantee. Therefore, we don't give guarantee in CA exam though. But if I am giving a guarantee that you will pass, and if you will not pass, I will refund. So my fees will be higher, na? Are you able to understand what I am saying? So what they are saying, guarantee is given. For that, what is the fair value of guarantee? Fair value of guarantee is 0.5. Means can I say whatever consideration has been received, this 90 crore, these are two part. One is for what? Transfer of asset. One is for what? Guarantee received. Guarantee given. So this consists of two part. One consideration has been received for the transfer of financial asset. One consideration has been received for guarantee given. Correct? So what will be journal entry? Can I say first journal entry will be bank account. How much consideration received for transfer of financial asset? To financial asset, what is the carrying amount? 95. So the difference will be loss. Loss is how much? 5.5. This point you understood? Then how much consideration received for guarantee given? Bank account debit, it is how much? 0.5. So can you say this is nothing but a income which should be recognized during guarantee period? Whatever consideration you are receiving for guarantee given, it is nothing but one type of income, but that income should be amortized to PL during guarantee period. So can I say it should be initially considered as pre-received income and then transferred to PL during guaranteed period. For example, guaranteed period is 2 years. This should be amortized to PL in 2 years. So we'll call it pre-received income, or can I call it associated liability? It is a liability now. Pre-received income is liability or not? We'll pass this journal entry. But can I say this amount will be transferred to PL over the period of guarantee? Correct. Now what India says, you need to also recognize one more asset that is known as continuing involvement asset. Continuing involvement asset. Continuing involvement asset. Because of some continuing involvement, because you have de-recognized the entire asset now, but to the extent of 5 lakh you have some involvement. You need to recognize a asset which will be known as continuing involvement asset, and that amount of that asset will be lower of carrying amount of asset transferred or the amount of guarantee given. So in this case, can lower will be 5 crore only. So this will be recognized at 5 crore. Understood? Because can I say in case of bad debt, this is your bad debt now. You can't de-recognize this much asset. You need to recognize an asset to the extent of continuing involvement. That the name of the asset can be continuing involvement asset. If you want some other name, you can give that name also. I'm going as per ICAI solution. Continuing involvement asset. But just try to understand. If suppose the amount is collected, so whether that amount is collected is your amount or that is other party amount. Other party amount, to can I say you, even though amount is collected, that amount does not belong to you, that amount belong to other party. So there is some associated liability also. There is some liability also. You will pass journal entry to associated liability. How much? 5 crore. This become one journal entry. Means in ICAI solution they have given one compound journal entry for this. What can be the compound journal entry? Batao. Bank how much? 90. Loss how much? 5.5. Continuing involvement asset how much? 5. To associated liability how much? 5.5 to financial asset how much? 95. 95 now. 95. This is the compound journal entry. Have you understood? Correct. What the Ind AS says. Come to Ind AS. Continuing involvement of entity in the transferred asset. If the entity neither transfer nor retain risk and reward of the asset transferred, if the entity neither transfer nor retain risk and reward of the asset and retain the control of transferred asset, entity continue to recognize the transferred asset to the extent of its continuing involvement, which is equal to what? Lower of carrying amount of transferred asset and the guaranteed amount. In our case it was 5 crore. Correct? Then the entity also recognize the associated liability which is initially measured at guaranteed amount 5 crore plus fair value of guarantee given 0.5. So you can see we have also recognized 5.5. Correct. The guarantee liability means fair value of guarantee shall be amortized to PL over the guaranteed period. That only I have said. You can see I have just given you one compound journal entry. Any difference of these should be transferred to PL as gain or loss. Understood? But I don't know whether this will be asked or not. But one question has been given in ICAI study material. Correct. Now let us come to important concept, that is derecognition of financial liability. Derecognition of financial liability. Now can you say financial liability will derecognize when the liability is extinguished? When the liability is extinguished. Extinguished means when the obligation is either paid or cancelled. Correct now. Either paid or cancelled or exchange or modified. Means can I say when paid towards journal entry liability account debit to bank, difference will be PL. When cancelled liability account debit to PL only. When exchange, so liability account debit to equity or whatever, exchange, liability account debit to new liability whatever. Correct now, exchange. So the difference will be transferred to PL. Only we need to understand in this case what will be the accounting treatment when the liability is modified. Means this is important from examination point of view. What will be the accounting treatment in case of modification of liability? Are you getting what I am saying? So that is only discussed is strategic debt restructuring modification. So what Ind AS says that if the modified terms are substantially different from original terms, if modified terms are substantially different from original term, then follow extinguishment accounting. Otherwise follow modification accounting. Have you understood? If modification terms are substantially different from original term, then follow what? Extinguishment accounting. Otherwise follow modification accounting. Extinguishment accounting means old liability will be de-recognized. New liability will be recognized at fair value. Modification accounting means what? Only the liability will be modified, but liability will not be de-recognized. Understood? What is important? This extinguishment accounting is important from examination point of view. Correct? Now one thing we need to understand, so how we'll understand that modified terms are substantially different from original term. For that, they have given one guidance. One guidance has been given. What they said, the terms are substantially different if A minus B is greater than or equal to 10% of B. They have given one equation. A minus B is greater than or equal to 10% of B. But if this equation is satisfied, then it means substantially different. If not satisfied, then it is not substantially different. Now we need to understand what is A, what is B. So A means what? Present value of cash flow under modified terms discounted at original EIR plus any legal fee paid on the date of modification. Any legal fee paid on the date of modification. What is A? Present value of cash flow under under modified terms. Present value of cash flow under modified terms, discounted by using original EIR plus any legal fee paid on the date of modification. What is B? B is nothing but carrying amount of existing liability. B is nothing but carrying amount of existing liability, or we can say present value of remaining cash flow under original terms, discounted by using original EIR. This is nothing but carrying amount at amortized cost now. Nothing but carrying amount at amortized cost. Have you understood this point? Are you able to understand? Correct. So I hope you have understood A and B. A and B, this you can calculate. Compare these. If satisfied, then extinguishment accounting. If not satisfied, then modification accounting. Correct. So what is the meaning of extinguishment accounting? De-recognize existing liability, recognize new liability at fair value. Now when I am saying new liability at fair value, what is the fair value? Present value of cash flow under modified term, discounted by using fair value. Fair value means at what? Current market rate of interest on the date of modification. Understood? Rule remains same. I am saying fair value as on today. So why you are saying original EIR? This was for comparison. This is comparing A and B. When you are comparing A and B, so it should be at equal terms now. If you are taking in this case original EIR, so in this also original EIR, then only they are comparable. So for equation it is original EIR. But when I am saying fair value of new liability, it should be present value of cash flow under modified term, discounted by using market rate of interest on the rate of modification. Understood? One second. What is the fair value of new liability? Bolo. Fair value of new liability will be present value of contractual cash flow as per modified term, discounted by using market rate of interest on the rate of modification. Correct. Can you say due to this there will be some gain or loss on de-recognition? So how to calculate gain or loss on de-recognition? It means new liability, fair value of new liability plus any fee paid minus what? Carrying amount of existing liability. This will be gain or loss which will be transferred to PL. Understood? Have you understood? Can we take one question based on this? Let me come to one question. Question 40. What they have given? Oh. 1 minute. Question 40. On 1st Jan 2020, XYZ Limited issued 10-year bond for rupees 10 lakh bearing interest at a rate of 10% payable annually on 31st December each year. The bonds are redeemable on 31st March 2009 for rupees 10 lakh. No cost of fee incurred, means there was no transaction cost. If there is no transaction cost, means EIR will be equal to market rate of interest. And if nothing is given, contract will be at market terms only. Means initially the contract was at market terms. Means this 10% was market terms only. Means contractual rate of interest is equal to market rate of interest. And if there is no transaction cost, EIR will be equal to market rate of interest. Are you able to understand this relationship? Correct? The effective interest rate is there for 10%. Thank you very much. This to we know. But if suppose they have given transaction cost, if I am preparing question paper, I will to give, but I am not preparing. Means from my point of view, they should draft the question paper from faculties only, na. Means we can give better questions. Believe me, we can give better questions. Means I can from one concept now I can create 1 lakh questions. This much expertise we have, and we can give better answer also with correct assumptions, but they are not giving us chance. What to do? Correct na? Because if we want to go into board of studies now, we need to stop teaching. And we'll stop teaching. So understood now. So we can't do that. Correct? Acha they are not asking to prepare question paper. The effective interest rate is therefore 10% on 1st Jan 2005, that is after 5 years. Means some modification will happen. The bondholder and XYZ Limited agreed to a modification in accordance with which the terms is extended to 31st December 2011. Means it has been extended. Means initially it was how much? 31st December 2009. Means extended by 2 years. Correct. Interest payment are reduced to 5%. The bonds are redeemable on 31st December 2000. Make even changes. It is 2011 only. The bonds are redeemable as on 31st December 2011 at rupees 15 lakh. This is also change. Initially it was redeemable at par. Now redeemable at 15 lakh. Legal cost and other fee 1 lakh incurred. My question to you all, just try to understand. Transaction cost is incurred. Normally this is doubt. Means every student have doubt about this. When I say transaction cost is incurred at the time of initial contract, at the time of modification. At the time of initial contract, means this was transaction cost. This was transaction cost now. Which was not given. But when I am saying legal fee and other fee incurred on the date of modification, whether this is transaction cost, this is the legal fee paid on modification. This is not transaction cost. Kasam khao. This is not transaction cost. Kasam khao. This is not transaction cost. Now believe me, same doubt will come to you. Abhi you are right. You are with me now. When you are with me, you are relaxed. Yes. When you are in front of teachers now, whatever I am saying, you will understand. But when you are not without me, means you are not without me in exam hall. There you need to apply the concept now by your own. And normally students do mistake. They think this is transaction cost. Calculate EIR. This is not transaction cost. This is what? Legal cost incurred on the date of modification. If you want to write down. This is not transaction cost. This is legal fee paid on the date of modification. This is not a transaction cost. Understood? Have you understood? Now, XYZ determined that market interest rate on 1st Jan 2005 for borrowing on similar term is 11%. Now, suppose in exam market rate of interest is not given, then what you will assume? In one question, they have not given market rate of interest on the date of modification. No. 10% was on original date. We need to find out on the date of modification. Then we'll assume this modified terms are at market terms. Then this 5% will become what? This is modified contractual rate of interest now. So we'll assume modified contract is at market terms. So if modified contract is at market terms, then modified contractual rate of interest will be equal to market rate of interest. Because one question already asked in exam, in that question market rate of interest was not given. That question was from ICAI study material only. Correct? So if question is silent about market rate of interest, always assume contract are at. So if modified terms, they have not given market rate of interest, what will assume? That modified contract is at market terms. Then market rate of interest will be equal to what? 5%. Understood? This is the second area where you are going to mistake. But in this question, though, they have given 11%. Correct. Record journal entries. Can we do it? Means very simple. Calculation wise, it is very simple. I need to only inform you what need to be done. Now, first we need to find out analysis of modified terms. Analysis of modified terms. Follow. Correct? Analysis of modified terms means what? Whether the terms are substantially different or not. For that we need to find out A and B. Then compare A minus B with 10% of B. Correct? So A is what? Present value of cash flow under modified terms discounted by using original IAR. In my question, what is original IAR? 10%. Correct. Modified terms, 5% is the contractual rate of interest. The modified terms is 5% extended by 2 years, means 7 year is what? Now modified terms, tenure is what? 7 year. Modified tenure is 7 year. Contractual rate of interest is 5%. Redemption amount is 15 lakh. Redemption amount is 15 lakh. Contractual rate of interest is 5%. Correct? बोलना रे. Now, in one point you can do mistake, but the 5% you will calculate of which amount? 5% of which amount? 5% is the modified contractual rate of interest. So 5% you will calculate for which amount? 16 lakh is what? What is 16 lakh? What is 16 lakh? अरे बोल ना. 15 lakh is the amount na. 16 lakh is what? Oh my god. माथा खराब. अरे 5% is always of nominal value. 5 rate of interest you applied on nominal value. Whether 15 lakh is nominal value, that is redemption value. Nominal value is 10 lakh only. Rate of interest you apply on which amount? Nominal value. In this question, what is the nominal value? 10 lakh. So always on 10 lakh. Third area where you can do mistake. I know the nervous system student where you can do mistake. This much experience I have. I am teaching from last 13 years. Last 13 years means I know where student can do mistake. But normally what happen when I do regular class, student don't listen only. They will not write where we do mistake. I know where you can do mistake. This is a 5% of nominal value. Nominal value is what? 10 lakh na. So what is the modified contractual rate of interest? Modified interest is what? 5% 10 lakh means how much? 50,000. What is the redemption value? 15 lakh. What is the legal fee paid? 1 lakh. Chalo, now you have understood. Now, so can you see, we'll find out what? We'll do analysis of modified terms. So first A is what? Present value of contractual cash flow under modified terms and legal fee paid discounted by using original EIR. What is original EIR? 10%. So can you give me first present value of contractual cash flow under modified terms? You need to find out present value of interest component. The present value of interest component means 50,000. And also 50,000. 50,000 discounted at a rate of 10% for how many years? 7 years. So this you can calculate. Then we need to find out present value of principal amount. Principal amount, what is the redemption value? What is the redemption? Modified redemption value? 15 lakh. So can you find out a 15 lakh present value at a rate of 10% for how many years? 7 years. This will come this amount. So this become what? Present value of contractual cash flow under modified terms. We'll add what? Legal fee paid. This become what? A. This become total become A. A, you understood? A, you understood? Are bolna rahi? Now we need to find out B. A, you understood na? Correct? Now we need to find out B. B is what? B is what? Present value of cash flow under original term discounted by using original. Yeah. Okay, it is nothing but carrying amount. It is nothing but carrying amount. Just try to understand. Whenever contractual rate of interest and market rate of means contractual rate of interest and EIR are same, so can you say the carrying amount at the end of each year will be nominal value only is 10 lakh. Just 10 lakh plus 1 lakh minus 1 lakh is equal to 10 lakh. Then again 10 lakh plus 1 lakh minus 1 lakh is equal to 10 lakh. Means can I say if contractual rate of interest and EIR are same, then amortized cost will be equal to initial liability only. Correct? So there is no need to calculate. अरे बोलना रे shortcut ना. But if EIR is different, then apply that amortization table to find out amortized cost as on this date. Amortized cost as on this date. Correct? So can you say without calculation we can add on carrying amount of existing liability on the date of modification is 10 lakh. Carrying amount of existing liability on the date of modification will be 10 lakh without calculation. Why? Because contractual rate of interest and EIR are same. Are you able to understand? If it's different, calculate. Now A minus B will be this minus this. A minus B will be 1,13,220. Now 10% of B will be what? 1 lakh. You can see A minus B is more than what? 10% of B. Therefore modified terms are substantially different. Modified terms are substantially different. And if modified terms are substantially different, you will apply which accounting? Extinguishment accounting. Extinguishment accounting. Now let us do extinguishment accounting. In extinguishment accounting, we need to calculate what? Fair value of new liability. What is the meaning of fair value of new liability? Fair value of new liability means what? Present value of cash flow under modified terms discounted at market rate of interest. What is the market rate of interest? What is market rate of interest given in the on the date of modification? 11%. Means whatever you have done for A, point of A in analysis, now do same thing for 11%. Correct? But here what? Can you say we need to find out present value of contractual cash flow under modified term discounted by using market rate of interest? That is nothing but 50,000 discounted at a rate of 11% and 15 lakh discounted at a rate of 11%. In this too you are expert, you can calculate this amount. This become new liability. Now we'll do what? Find out gain or loss on modification, gain or loss on de-recognition. We will say fair value of new liability is this amount plus legal fee paid 1 lakh. This is the total payment we are doing now. Means this amount is payable, this is already paid. But under existing liability, how much amount was payable? 10 lakh. Means we are paying more. Due to modification, we are paying more now. This is payable. 1 lakh we paid due to modification. Actual liability was 10 lakh. We are paying more. So whatever we are paying more, that is loss due to what? De-recognition. So this is known as loss due to de-recognition or extinguishment, you can say. This will be transferred to PL. What journal entry you will do? What journal entry? Can you say old liability will be debited? New liability will be credited? Whatever you have paid legal fee will be what? To bank? This is not transaction cost. Legal fee paid on the date of modification, not transaction cost. Here new liability is recognized fair value, not fair value minus transaction cost. This is the doubt. This is a new liability will be recognized as fair value minus transaction cost. 1 lakh is transaction cost. Why you have not deducted? Matha kara. Understood? Doubt is what? When we have done initial recognition, we have said initial recognition financial liability is fair value minus transaction cost. The doubt is what? Sir, legal fee paid is a transaction cost. Why you are not deducting from financial liability? This is not transaction cost. Understood? And the difference will be loss. Journal entry is very simple. Now can in subsequent accounting you will do amortized cost by applying what? By applying EIR. And EIR will be equal to market rate of interest. Why? Because there is no transaction cost. Confusion? Huh? Just try to understand. 1 second. When you are doing subsequent accounting is done at amortized cost by applying EIR. You need to find out what is EIR. Now, EIR may or may not be equal to market rate of interest. Whether there is any transaction cost, so EIR will be equal to what? Market rate of interest. Just think like this. 1 second. Initial accounting you have done. Now subsequent accounting by applying what? EIR. EIR may or may not be equal to Is there any transaction cost? So EIR will be equal to market rate of interest. If suppose they have given, suppose in this case there will be no transaction cost, but suppose transaction cost given, then EIR you need to recompute. In this there will be no transaction cost. In exam they will never give transaction cost. Understood? Then subsequent accounting you can do it. You can do it by your own. What is subsequent accounting? Interest expense account debit to bank, difference will be financial liability. Then interest expense account debit to bank, difference will be financial liability. Simple now, that accounting you need to do. I hope you have understood. Correct? One note also I have given in regular class. Modification cost is not considered as transaction cost and is not deducted from fair value liability. On the date of modification, market rate of interest is equal to what? Effective rate of interest. Means in regular class I give in detail writing, but then also my student will have also the same doubt because they will not revise. If you will not revise, then what? Confusion. However, it is very simple. Whatever I am explaining, if you are understanding, it is very simple now. Correct? I think understood. Now, the next point is what? If we follow modification accounting, then what? So normally from examination point of view, they will not ask modification accounting. They will ask extinguishment accounting only. Why? Because for modification accounting, Ind AS is silent. Ind AS only says if modified terms are not substantially different, then apply modification accounting. But what is modification accounting? That is not given. Because of that reason, ICAI has given two alternative modification accounting. Means as per ICAI, there are two alternative modification accounting. Ind AS is silent. Are you able to understand emotions? So I will just read it. There is one question given in ICAI, illustration given, question also not given. That can you do by your own? I will just read it. It is very simple. Modification accounting, Ind AS 109 is not clear as to the accounting treatment if the 10% test is failed. ICAI has given two alternative accounting approach. First accounting, recognition of gain or loss on the date of modification. What they are saying, entire gain or loss due to that modification will be transferred to PL immediately. So what they said, any legal fee paid on the date of modification will be recognized as an expense immediately. What Jain will do? Modification cost account debit to bank and modification cost will be transferred to PL. Correct. Then what they are saying, this liability will be restated. The liability will be restated at a present value of modified cash flow discounted by original EIR. The liability will be restated at present value of cash flow under modified term discounted by using original EIR. So restatement, suppose initially carrying amount 10 lakh. Now due to this restatement become 9 lakh. Difference is there, the difference will be also transferred to PL. Correct? Any difference between carrying amount and restated amount will be transferred to PL. Can I say you can do it by your own? If question ask, अरे बोलना रही, yes sir, बोल दे yes sir, yes sir बोल, because I will not take question. You can do it or not. Second alternative is what? Gain or loss will not be transferred to PL immediately, it will be deferred. Means it will be also amortized with interest expense. So what they are saying in this case, the modification cost, means legal fee paid on the date of modification, will be reduced from existing liability. Means it will be considered as repayment of liability. So what journal entry you will do? Liability account debit to bank, liability will reduce, liability will be reduced. Now they are saying calculate new EIR. The new EIR will be the discount rate at which present value of cash flow under modified terms is equal to the adjusted liability. Means suppose the carrying amount is 10 lakh minus 1 lakh modification so on. This become adjusted liability. Now you need to find out EIR. So EIR will be the discount rate at which present value of cash flow under modified terms will be equal to 9 lakh. And if you calculate this, so can you say there is no expense on this date? all the expense will be automatically recognized with interest expense only, na? So it means that expense has been deferred and no expense recognized on the date of modification. This second alternative, from my point of view, second alternative is more appropriate. This is my suggestion, not ICAI suggestion. ICAI has given two approach. If I am ICAI, I'll follow what? Approach 2. Approach 2 is more okay. Correct? But easy is what? Approach 1. So apply approach 1 in exam. Correct? Approach 1 is more easy, na? Approach 2, thoda sa calculation is more, because you need to calculate UER. The effective interest rate is recalculated. This rate of interest is the present value of future cash flow as per modified contractual terms is equal to the adjusted carrying amount mentioned above. Got it? But both are easy. Can you do it by own? But from my point of view, they will not ask this, they will ask extinguishment accounting. Chalega? Understood? Then there is one question about debt equity swap. Debt equity swap is not very easy, means exchange of liability in equity. So entry is what? 55 से liability account debit to what? Equity share capital. The liability will be de-recognized at carrying amount. So what will be this amount? So this amount, what will be this amount? Means at what amount you recognize equity. Correct? So what they said, whenever equity instrument are issued a creditor to extinguish the financial liability, correct now? So equity instrument are recognized initially at fair value of equity instrument issued. Means it will recognize the fair value of equity instrument issued. Fair value of equity shares. Fair value of equity shares. But if it cannot be measured reliably, then it will be recognized at fair value of liability extinguished. Now fair value liability extinguished means what? One second. You are exchanging liability with equity shares. Is you allotting equity shares? General entry is liability account debit equity shares. Liability will be de-recognized at carrying amount. We need to find out at what value equity will be recognized. The first preference is what? Fair value of equity shares issued. Fair value of equity shares issued, समझ गए ना? At market price or intrinsic value, whatever. Fair value of equity shares issued. That will be given in the question. But suppose not given. Yeah, it cannot be measured reliably. For example, in case of unlisted company, it cannot be measured reliably. Then second preference will be fair value of liability extinguished. Means the fair value of this liability. Fair value is not carrying amount. What is the fair value of this liability? If you want to calculate fair value as on today, means present value of remaining contractual cash flow discounted by using what? Fair value means current market rate of interest. Arey Baba, whenever you are calculating fair value, for fair value you are using what? Current market rate of interest, na? I am not saying carrying amount by original EIR. But when you are calculating fair value by using what? Current market rate of interest. Bolo, current market rate of interest. Understood? Of similar instrument. But this type of question they will not ask. If they will ask, they will give fair value equity shares only. Any difference will be transferred to PL. Any difference will be transferred to PL. Correct. But very simple topic. Topic number 5 also over. Topic number 6 is impairment of financial asset. Impairment of financial asset. From my point of view, important topic. But from ICAI point of view, I don't know. Correct now. Means if I am preparing question, I will pakka give. Means I like this topic very much. Because it is very much practically dealt concept. Means wherever you go, you need to impair. Impairment is to always we are doing. Means it is impairment of financial asset. Impairment of PP we have done. Ind AS 36. Impairment of intangible asset we have done. Everything we have done. Now we are coming to impairment of financial asset. Impairment of financial asset. Now, impairment of financial asset, to what they are saying, when I am saying impairment of financial asset, to what financial asset are cover in this topic? So financial assets that are measured at amortized cost are covered. So can I say it means that instrument is covered? Financial assets that are measured at FBTOCI. So only debt instrument, equity instrument is not covered. Understood? Why? Because just try to understand, when I am saying equity instrument, there is no contractual cash flow. There is no contractual cash flow. So it is already recognized as fair value. It is already recognized as fair value. So it is already impaired now. Based on fair value. Means can I say when I am saying impairment, it should be impairment either based on fair value or based on cash flow. याद करो, value in use or fair value less cost of disposal. If you are saying equity instrument are carried fair value only, so already impaired na. Why you are impairing again? But when you are saying debt instrument, so can you say if it is FBTOCI, you have already impaired based on fair value. But right now you are testing impairment based on future cash flow, whether that is recoverable or not. Whether that amount is recoverable or not. Therefore, in this topic, only what is covered? Amortized cost, FBTOCI, debt instrument, and lease receivable. Ind AS 116 says that impairment of lease receivable will be as per Ind AS 109. Means initial recognition and subsequent recognition of lease receivable is done as per Ind AS 116. But impairment के लिए यहाँ आ जा. Ind AS 116 says that for impairment of lease receivable go to what Ind AS 109. Okay, चलेगा. Understood? It means financial asset measured FBTPL and financial asset measured FBTOCI equity instrument are not required to be tested for impairment under this topic. Have you understood this point? Correct. Now, for impairment, what is the formula? Formula is what? You need to find out ECL. ECL means what? Expected credit loss multiplied by probability of default. Understood? This is the formula. ECL means what? Expected credit loss multiplied by probability of default. This is known as credit loss allowance. Means we need to create an allowance of this amount for impairment. Credit loss allowance. What is the formula? ECL into probability of default. Now, so what is ECL? Can you say ECL means what? Present value of cash flow which are not expected to be received, discounted by using original discount rate, original EIR. Understood why we are using original EIR? Because we are not calculating fair value. Correct. So what is the ECL? Present value of cash flow which are not expected to be received, discounted by taking original EIR. Means can I say expected cash flow which are not going to be received means what? Expected cash flow under the contract minus expected cash flow which we are expecting to received. We can say in this way also. Correct. What is given? For financial asset, a credit loss allowance is the present value of difference between A and B. A is what? Contractual cash flow that are due to the entity under the contract and the cash flow that the entity expect to receive, discounted by using original EIR. Means simple word can I say? This is nothing but ECI is nothing but present value of cash flow which are not expected to receive, discounted by taking original EIR, multiplied by probability of default. Now this probability of default is measured either by taking 12 month or lifetime ECL. Means you can see they have given the concept of 12-month ECL or lifetime ECL. Now we need to understand when to use 12-month ECL, when to use lifetime ECL. 12 month means what? 12-month ECL means what? This default is going to be happen within 12 months. And when I am saying lifetime, the default may happen during the lifetime. Achha, you only say probability default will be more in which case? If you are taking lifetime or 12 month? Huh? What nalayak? Lifetime. Suppose I have taken loan from you. Initially whether I will do default. I am a good debtor, right? But I may become bad after 5 years. If you are taking 12 months, I am a good debtor. That's why you have given loan to me. I went to the bank. पूरा तो चिट्ठी निकाल दिया मेरा. Means right now, recently I have taken loan. Arey baba. At the end I understood why I have taken loan. Believe me, actually I was in need of some immediate cash. I was thinking to purchase a property, but liquid cash nahi hota hai na. So I said why to tail my investment, better take loan. And before COVID-19, during this period the rate of interest was very less. Now it increased. Understood now? Believe me, I went with my annual income is good. Means it is my return of income is also good. Correct now? I went to the bank. Means to take the loan, they have asked me so many things. They have taken my so many property as security. Then they have given loan. It taken my 6 to 7 months for that loan. Because my native place is not here now. My native place is somewhere else. But I have understood, bhai, loan in India, it is very difficult. Loan they give to Vijay Mallya, but they will not give to us. To middle class people now they will not give loan. Even though we have a good income. Are you getting what I am saying? Means they are just identifying whether I am a good debtor or not. I am a good person or not. Are you getting? Means they have taken my sales bank account, my father bank account, my mother bank account, my brother, everything they have taken. At the end they are saying, okay, but whatever you are asking, they have given 50% of amount of loan. Chhod yaar. Why I have taken loan? I would have sold my investment only better. Correct na? Means just try to understand what I am saying. So what I want to say, initially I will be good debtor na, but in the lifetime I may be, the probability to default may be higher when I am taking lifetime ECL. It will be less when I am taking 12-month ECL. Understood this? But now doubt will come when 12 month, when lifetime. Can you say an exam that will be given? Either they will give 12 month or they will give lifetime. Means from exam point of view, okay. Means from exam point of view, discussion over. From exam point of view, discussion over. Now you want me to discuss more? I can take one question, discussion over. But you can see there is a lot of discussion to be done. It is not easy topic. You can see so many discussion. Just see. See. It will not be over only. But exam point of view, discussion over. So can I take one question based on this? However, I would like to discuss one more point, which is maybe asked in exam. What they say, there are 3 stages of impairment. First stage, second stage, third stage. These 3 stages of impairment. First stage, second stage, third stage. Correct now. First stage means what? The credit risk has not increased significantly from initial recognition. Means we are a good debtor. Credit risk has not increased significantly since initial recognition. Means we are good debtor. So it means right now we are good debtor. Second stage, credit risk has increased significantly since initial recognition, but there is no objective evidence of default. Means it might happen due to some reason I am not able to pay on due date. Risk is how? Means if I am not paying, doubt will come now. So now I am become doubtful debtor. But there is no objective evidence of impairment. This second stage. Credit risk has increased significantly since initial recognition, but there is no objective evidence of impairment. Third stage, when we become credit impaired financial asset, means when there is an objective evidence of impairment. Suppose some news came about my financial difficulties in the market. So now I become financially credit impaired financial asset. Means now we become what? More than doubtful debtor. Means if you remember banking company, तो इसको छोड़ दे. Good debtor, this is what standard asset. This substandard asset, this is doubtful asset. You remember? We can say in this way. There are 3 stages. So what they say? In this case, 12 months. In this case, lifetime. In this case, lifetime. Understood? Have you understood? So then why this is also lifetime, this is also lifetime? So there is one difference. Whenever we are into stage 1, interest will be calculated on gross amount. When we are into stage 2, interest income on financial asset will be calculated on gross amount. But in this, interest income will be calculated on net amount. This is the difference. Net amount means what? Net amount means what? The carrying amount of loan or receivable minus credit loss allowance. This is net amount. Credit loss allowance is nothing but provision for doubtful debt, but now we don't call it provision for doubtful debt. Understood? This is net amount. Means in the third stage, interest will be calculated on net amount. First stage and second stage, interest will be calculated on gross amount. This is the difference. Difference you understood? Have you understood this point? Bolna re. Correct? This much is okay. Can I take one question? Can I take one question? Because this topic, I don't know whether they will ask this much. Chal theek hai. I will take 2 questions which I feel they can ask in exam. Question 47. On 1st April 2017, A Limited lent 2 crore to a supplier in order to assist them with their expansion plan. The arrangement of the loan cost to the company 10 lakh. Means 2 crore minus 10 lakh become fair value minus transaction cost. Means it is what? 1 crore? Sorry, plus. Fine. 2 crore 10 lakh. The company has agreed not to charge interest on this loan to help the supplier's short-term cash flow, but expected the supplier to repay 2.40 crore. Means contractual rate of interest 0, but redemption amount is 2.40. As calculated by finance team of the company, the effective annual rate of interest is 6.9%. On 28 Feb 2018, the company received the information of poor economic climate has caused the supplier significant problem. My question to you all, this is which stage? Stage 1, 2, 3. No. The company received the information that poor economic climate has caused the supplier significant problem. Means, can I say significant? There is an objective evidence of what? Impairment. Stage 3. Stage 3. Stage 1 to good. Standard asset. Stage 2, it has increased but there is no evidence. Means suppose we are doing some late payment. Normally we do late payment. We are Indians na. We don't do anything on due date. We do. Are bolna re. Means normally we don't do. We never file our income tax on due date. We wait. Means believe me, I call to my. I am also chartered accountant, but I don't know file my income tax return. Okay, sorry for that. Because initially I used to file, then I understood, yeah, itna nahi hai. Because we will forget na to file our income tax return. And so much accounting, itna, now we don't have time also. So don't feel bad about that. We should file our own income tax return na. The last 3 years, once GST came na, I have given my entire file to one of my friend. Correct na. After GST na, nahi hota. GST changed entire thing na. So I said no. Up to service tax, I used to file my income tax and service tax return. Once GST came, I understood now I can't read GST. Okay, na? So one day I called my CA. So I said due date came. But ठीक है ना, we'll do rectification. Don't worry. Well, अच्छा. But don't worry, we have filed your return. I say we'll again file the rectification return. बोला माँ क्या? But you are chartered accountant. We do like this only. Correct na? Dekho, yes. Correct na? So what I am saying, we never do anything on due date. We are Indians. So it does not mean na we are bad na. Indians are good only na. अरे बोलना रे हाँ Indians are very good people. Indians are very good people. These Indian people are very good, really, really very good. But will not do anything on due date. These are by nature, default nature. But can I say there is an objective evidence? It means now we become what bad. Correct? In order to help the company agree to reduce the amount repayable by them on 31st March 2019 to 2.20, means out of 2.40, how much is now receivable? Means what is not receivable? So that become what? ECL. We can calculate ECL. Can I say in third stage, if probability of default is not given, it will be always 100% in third stage. However, from exam point of view, whenever probability default is not given, always assume 100%. Always assume 100%. Such as accounting treatment. Can we do? Means everyone. I am just explaining this through one account so that you can understand. But what is the initial date? We are preparing one loan account. Loan account, na? What is the initial date? 1/4/2017. We'll pass one journal entry to bank. Loan account debit to bank. It will be 2.10. Correct. Then on 31st March 2018, we recognize interest income, but at what rate? EIR. How much EIR? 6.90. How much? 0.15. Then 31st March 2018, by bank how much? Nil, 0. No contractual cash inflow. By balance carried down how much? How much? 2.25. This you understood. Correct. Now, on which date? They have said on 28th Feb 2018. Oh. On 28th Feb 2018 means before this date. Before this date, na? Correct. On 28th Feb 2018, what can I say? Impairment will do at year end only. We received the information that this party become nalayak, but impairment loss will calculate on 28th Feb or 31st March? 31st March. My question to you all, on 31st March, we will first calculate carrying amount, give impairment loss. Carrying amount means, can I say this journal entry will be done before impairment loss? अरे बोलना रे, before impairment loss? First impairment loss, give first carrying amount. Carrying amount. So first you will calculate carrying amount, then impairment loss, na? Means this interest income is calculated before what? Impairment loss. So in this year, no question will arise about net amount or gross amount. Gross amount only because there is no credit loss allowance. Are you getting what I am saying? Now we need to prepare one more account. Credit loss allowance account. On 31st March 2018, we'll pass one journal entry, impairment loss account debit to credit loss allowance, and this impairment loss will be transferred to what? PL. Correct. But we need to calculate this amount. So this amount will be equal to what? Batao. This amount will be equal to where? Right now we are standing यहाँ पर 31st March 2018. What is the redemption date? 31st March 2019. Correct. How much amount was originally supposed to be received? 2.4. Now how much we are receiving? 2.2. How much we are not receiving? 0.2. We'll calculate present value by using original EIR. What is the original EIR? At what rate? 6.9%. Can you calculate? Are you able to understand what I am doing? How much? How much? 0.02 into, oh sorry, 0.2. So 0.2 into 1 year. 1 year discounting. How much? 0.935. How much? 0.187. 0.187. This is ECL. ECL is this multiplied by probability default. That will be 100%. So into 100% will do. So credit loss allowance will be 0.187 only. So we'll do 0.187. 0.187. And this will be 31st March 2018 by carried down. By carried down now. By PL now. This is credit loss allowance account. Impairment loss will be transferred to PL. Means my journal entry impairment loss account debit to credit loss allowance. Journal entry is what? Impairment loss account debit to credit loss allowance. Credit loss allowance will be shown in the balance sheet by way of deduction from loan. Understood? This is nothing but provision for doubtful debt account, Ray. I carried down how much? 0.87. Done. They have asked accounting for this year only, na? Done. Now see what they have done. Same thing but in para format. They have given 0.187. Check karo 0.187. Bolna re. Same thing they have done. What was the interest amount we calculated? Interest amount 0.14. 0.14 means they have done in full figure. They have done also debt null. You can now read. Have you understood? Have you understood? Bolo. Correct. Good question. In exam follow suggested solution. Because they have not asked journal entry, na. They have not asked account. They have asked suggest accounting treatment. So you can do by writing, first write on as per Ind AS and then give journal entries also. If they give suggest accounting treatment, so you can give journal entry, but don't prepare account. Correct now. What was the requirement of the question? Suggest the accounting entry. So we should pass accounting entries only, na. I will say they have not given correct answer. Suggest accounting entries. Accounting entry to accounting entry, na. So you need to pass journal entries only. You can do it now. Correct? Yes, sir. One more question. This question is also expected from my point of view. Okay? Entity purchased a debt instrument with a fair value of rupees 1000 on 15 March 2001. Correct? And measure the debt instrument at FBTOCI. Debt instrument at FBTOCI. Understood? It means it is with or without recycling. Debt instrument at FBTOCI. It is with or without recycling. With recycling, the instrument has an interest rate of 5% over the contractual term of 10 years and has a 5% effective rate of interest. Means contractual rate of interest and EIR are same. At initial recognition, the entity determined that asset is not purchased or original credit impaired asset. Means it is not an originally credit impaired asset. For example, sometime bank sold a NPA now. If I am purchasing NPA, it is originally credit impaired asset. Originally nalayak person. Correct now. So they are saying it is not an originally credit impaired asset. Ignore it. Ignore it. Okay? On 31st March 2001, the fair value of debt instrument has decreased to rupees 950 as a result of changes in the market interest rate. The entity determined that there has not been significant increase in credit risk since initial recognition. Stage 1, Stage 2, Stage 3. Stage 1, and the ECL should be measured at an amount equal to 12 months this year. Understood? 12 months this year. Correct? Which amount to rupees 30. Means they have given credit loss allowance. Means they have given ECL. Correct? Yes, sir. On 1st April 2001, the entity decided to sell the debt instrument for 950, which is fair value as on this date, past journal entry. Can we do? Batao. It was purchased on which date? It was purchased on which date? 15th March. What journal entry? Financial asset account debit to cash? 1000, 1000. Correct. Then, can you say, everyone, I will do better. I will explain you. First journal entry will do what? Financial asset account debit to? Financial asset account debit to? Bolo. Financial asset account debit to? Bank. How much? 1000. Now it is given that the value become 950. So first journal entry will what? First journal entry will do on 31st March. What journal entry? Financial asset account debit. Achha, it is decreased na. So OCI will do OCI account debit. OCI, FB OCI reserve. Account debit to what? Financial asset. It will become 50. Now on this day there is an impairment loss. Now can you say if it is impairment loss, it means out of this loss 30 will be transferred to PL. So what journal entry we should do? Impairment loss, PL, account debit to what? OCI only na? OCI, FB OCI reserve. Understood? This is 30. Understood? The journal entry have you understood? This journal entry have you understood? This question I am doing for this journal entry only. In suggested solution they have given one compound journal entry. In solution they have given one compound journal entry. Correct? Now next day on 1/4 it was sold. It was sold at 950. So what journal entry? Bank account debit to 950 only to financial asset 950. No gain or loss. But can you say on de-recognition, entire cumulative gain or loss will be recycled to PL. So what journal entry will do? PL account debit to OCI, FB OCI reserve, how much? 20. Have you understood this entire journal entry? Understood? Correct. That is only given. Check kar lenge. Same journal entry has been given. So can I conclude impairment also done? Impairment also done. Impairment done. Impairment done. You can see topic number 6 done. Now coming to derivative. Derivative financial instrument. So derivative financial instrument from exam point of view it is very easy. Only one question they have given. I will take that question only. Only that question. And they will ask that question only. But I am assuming that you know future option, call option, put option. So I am not explaining that. In my regular class, so I start from the beginning derivative. I will explain forward contract, call option, put option, future, everything. That assumption I am taking, you know everything. Now derivative instrument is always held for the purpose of trading. Now derivative are of two types. One is held for trading purpose. One is held for hedging purpose. Now if derivative is held for hedging purpose, then Ind AS 109 says apply hedge accounting. Hedge accounting is a separate topic. So right now in this topic we'll assume derivative is held for the purpose of trading. Held for the purpose of trading means what? FBTPL means initial recognition at fair value, subsequent recognition at fair value. Any difference will be transferred to what? PL. Can I say very simple? Can I take one question? Can I take one question? Yes, sir. Come to one question. This question. Means they have given only one question. If they will ask this question only. On 1st Jan 2001, STEM company agreed to purchase $20,000 from JT Bank in future Means this is future contract. So they enter in a contract to buy $20,000 on 31st December 2001 at a rate equal to 68. This is forward rate na? Forward rate. Same company did not pay any amount upon entering into a contract. So of course on future contract no consideration is paid, if you know. Option may only premium is paid na? Correct. Same company is a listed company in India. Okay, thank you very much. Following the principle of Ind AS 109, you are required to record the entries for each quarter ended. Each quarter means they are assuming that they are preparing financial statement at each quarter. So we need to do subsequent recognition for each quarter. For the purpose of accounting, please, they are requesting use. Please use the following information. Of course, we'll use. We need marks, Ray. We'll use na. Representing mark to market fair value of forward contract. Means they have given fair value of forward contract. Now, if you have done SFM, whenever fair value is given in negative amount, it means what? There is an obligation to pay. Whenever there is a fair value positive amount, means there is an obligation to, there is a right to receive. Means it is unfavorable, this is favorable. यही मतलब है ना? Means this is financial liability, this is financial asset. Are you getting what I am saying? Now, what they have given? But initially, what is the date on 1/4/11/2001? Can I say initial fair value is nil? Because no consideration is paid. Then first quarter, what is the fair value? Then second, third, then last. In last, what is the spot rate? And we have done contract to buy $20,000 at what rate? 68, 66. And we have done contract to buy at, now you can see, if we have done a contract to buy at 68 and if it becomes 66, for the favorable, unfavorable. Arey Baba, you have committed to buy at 68 and now it becomes 66. Unfavorable na? Unfavorable. I am assuming you know future call put. I am not, because I don't want to enter into that. That assumption I have taken, because I am not teaching SFM. So can you say unfavorable? Unfavorable, what amount? 2. So it becomes 20,000 into 2. So there is an obligation to pay how much? 40,000 negative ho gaya na? 40,000. This is the fair value at the end. This becomes fair value at the end. Means, just try to understand. Initially, 0 become this. So there is a loss of what? 25,000. Loss of 25,000. Then 25,000 become 15,000 na? So liability decreases, it become gain. If 25,000 liability become 15,000 liability, it become gain now. So second quarter gain how much? 10,000. Then liability become asset. So there is a gain of how much? Gain of how much? 15,000 negative become positive 12,000. So there is a gain of 15 plus 12. Your liability decreases, it become asset. So 15 plus 12 is gain na? Mathematics, 27,000. And then liability become asset, become liability again. Positive amount 12,000 become 40,000 negative amount. How much loss? 52,000 loss. 12,000 plus 40,000. Can I say this you need to calculate by your own? Now we can do the journal entry. Batao. On 1/1/2001, what journal entry? No journal entry. As no consideration is paid on 31st March na? On 31st March 2001, what journal entry? We'll say fair value loss, transfer to PL, account debit, how much? We will say to derivative financial liability, how much? 25,000, correct? Then on 30th June 2001, on 30th June 2001, what journal entry? Gain. The journal entry decrease in liability. To derivative financial liability account debit to fair value gain. What is the amount? 10,000. Next quarter, what journal entry? Derivative financial liability become derivative financial asset. So derivative financial liability account debit how much? Now derivative liability decreases by how much? How much decrease in liability? Decrease in liability how much? Liability decreases by 15,000 now. An asset created by how much? 12,000. What you are saying, Ray? Better I will write down. The next journal entry is derivative financial liability account debit to fair value gain, transfer to PL, how much? 50. Oh my God. 10,000. No? 10,000. Now okay. But the third quarter is what? 30th September. Your liability decreases by how much? 15,000. Your asset will be recognized at what amount? 12,000. The fair value gain is how much? Transfer to PL 27,000. Then last settlement. On 31st 12 2001, what journal entry? Now there is a fair value loss. What is fair value loss? 40 not, 40 not. It's not 40,000. 52,000. Dekho, in class, everything explained, you are doing mistake. Exam, what will happen? Concentrate. But a derivative financial asset decreased by 12,000 and derivative financial liability is recognized at, this is the journal entry now. Correct. So now we have a derivative financial liability of 40,000. Now on settlement date, there can be either cash settlement or physical settlement. Means cash settlement or delivery settlement by delivery. Okay. In this question it is given it will be physically settled. But if cash settled means net amount is settled in cash. Means 40,000 we need to pay. So what journal entry will do with cash settlement? Derivative financial liability account debit to bank or cash. How much? 40,000. But it is given the question they want to purchase what dollar. It is given. Check karo. Means till the date of actual purchase of dollar. Means they want to purchase dollar. So what journal entry? So they will purchase dollar na. What journal entry will do? Correct. Purchase dollar means they will purchase dollar. The bank account dollar will come. Correct. Batao. They will purchase dollar at 20,000 into 68 not. 68 is what? Contract rate na. What is the current value? So it will be recognized at 66. Means dollar is your asset na. So in each asset will be recognized at current fair value. But you are paying how much? Can you see you are paying rupees? So 20,000 into what? 68. And the difference will be nothing but derivative finance. Have you understood? Correct? Understood? Now, what I will do for today, I will do this much only. Okay. Do this much only. I'll continue the balance part tomorrow. Okay. Today we have taken class for what? Small number of hours. We will cover it in some other day. Okay, but financial instrument more or less completed. More or less completed. Some points are left. Hedge accounting, I will take only one question, whatever is given in some recent RTP. So only one question is there, so I will take that question to explain you that. Then there is one concept of embedded derivative. So embedded derivative is also important. That question, that point also I will take. Then there is one definition part we left. That point means 3 points I will do. Balance point, from my point of view, this is not important. So I will try to ignore that. That is theoretical point. So that you can do it by room. Correct now? Understood now? There are 3 points which is now left from my point of view. Derivative financial instrument, this topic is over. Now coming to hedge accounting. In hedge accounting there are 2 parts, fair value hedging and cash flow hedging. So fair value hedging they have not given any question. They will give only, they have given one question on cash flow hedge, which is also recently added. So from my point of view that is important. So I will take that part into consideration. Then there are some miscellaneous concepts in that embedded derivative is important. So I will take embedded derivative. Then embedded derivative I will do full. Then this executive contract is theory, you can do it by own. This is definition part. Point number 3, this also I will take because otherwise definition remain incomplete. I will take this point also. Then the balance point, you can see whatever balance point now, either I have done or you can do it by own. Either I have already done. Puttable instrument, this is theoretical point. This already I have done. This is option, optionally convertible debenture, this already I have covered. Correct now? So this whatever I have done. Okay, acha, one more point is there. They have given one question on financial guarantee. So I need to take financial guarantee also. Okay. So balance part I will take tomorrow. Okay. Today I am thoda sa feeling but dizziness. Correct? So can I take balance part tomorrow? Okay. Thank you very much. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Tomorrow time will be same. No changes in time.